It's a lower negative after a really tremendous, I mean, truly impressive week of gains on the S&P. To see big tech disappointing the way it did, ex-Apple, Alphabet, Microsoft, Amazon, Meta, just hammered after earnings, and your equity market still posted a really decent week of gains on the S&P, on the Nasdaq too. Elsewhere in the bond market, we look a little something like this, 2s, 10s and 30s. Think about where we've been a couple of Fridays ago on a 10-year, 433, very close to 434. On a 2-year, a couple of Fridays ago, we were at 463. Right now, a 2-year, 447. Yield higher by 6 basis points. On a 10-year, just north of 4%, 4.03%, up by a couple of basis points. Got to talk about the euro as well, opening the door maybe to a step down at the ECB and
just keep going.
Then getting hammered by CPI. Euro dollar 99.32, down a third of 1%. Inflation earlier this morning, Bramo, 10.7%. in the Eurozone. Yeah. Record high CPI.
Versus the 10.3% expected by analysts. At what point is that going to be a problem? The analysts keep getting wrong how quickly inflation keeps accelerating. That is a problem in and of itself.
What I love about the European numbers is the regional breakdown going into the headline print. So we basically knew we'd get an upside surprise once we got the numbers from Italy, from Germany, from France. And your point on that, I think, is tremendously important. To see Germany and the inflation numbers there just run away in the way they did is just remarkable at this time of the year still.
It's a game changer, and it raises a question of how much of a handle some of these central bankers have on it, especially when they say, came out of nowhere, like you pointed out.
They got a handle on it.
Yeah.
They sound like politicians, don't they?
How do you feel about that? All right, we'll get to that later.
Inflation came out of nowhere.
Yeah, well, all right.
We can
get there. Yeah, the cynicism, which is warranted, by the way. Let's get some movers that are a little bit safer. Right now, I'm looking at AMD, Advanced Micro Devices. This is one of the chip makers that are falling today as a result of what's going on over in China, and that's why I really paired this with Alibaba and Baidu. All of those shares declining. COVID-related shutdowns just keep happening, and now they're targeting Foxconn Technology Group, which is one of the biggest iPhone producers. And the crackdowns have led to these huge protests with people fleeing the factory. And now you have the possibility of iPhone manufacturing going to other places in China. It just highlights, especially on the heels of that weaker than expected data, John, how much China is still very much in a pandemic that the rest of the world seems to have moved on from.
I was just getting the data out of China on my screen. This came out overnight. 49.2 on manufacturing, 48.7 on non-manufacturing, the two PMIs there. Not just China, but Europe too now in the 40s. So if you think about the three-legged stool that is the global economy, China, the Eurozone, the United States, you've got China in the 40s, you've got the Eurozone in the 40s, and we get the ISM for America tomorrow. Things aren't looking great.
Well, and China cannot be the engine of growth, and it cannot necessarily be the supplier that it once was because of some of these disruptions. And so what does this world look like with a China of a sub 5% growth for a longer period of time? These are some of the things that are kind of factoring in to the longer-term view versus the short-term view. I'm also looking at some of the commodity space, BP, for example, which is going to be reporting earnings this week. Those shares lower, as are ConocoPhillips, also reporting earnings just directly on the heels of oil prices that are going down. Why? Possibly because of those China numbers, right? I mean, that's a big thing. And I put Barrick Gold in there, down by about 0.25% right now. Do you know that gold is poised for its longest losing streak going back to the 1960s?
Did not know that.
And to me, this is fascinating. We're talking about inflation on a monthly basis, 7 months straight. But to me, it's just striking at a time when you talk about inflation and gold in the past being an inflation hedge. It has not worked, and it highlights how difficult this market's been.
This is Operation Kill Inflation.
Yeah, well, I mean,
now, isn't it?
Well, but why have we not gotten gold rallying if we're still having inflation now?
Behaving in line with break-evens, perhaps as well, in the market, taking down inflation expectations. That's what the market's positioned for, is effectively what I'm saying. It's not my opinion about what I think should happen. It's just what the market's been priced for.
In a previous era, when people were worried about inflation, they went into gold. They didn't say, what's going to happen with break-evens? I need to hedge my gold position with that. So I'm just saying, it's notable that there's been such a long losing streak here.
I think it was Hugh Hendry on Friday that said gold didn't perform the way he thought it would in the financial crisis either. That was the point that he made too.
When you financialize a shiny metal, it does weird things.
Yeah.
Just Just carry on.
Okay, good. Get to Mike Wilson and Morgan Stanley. Lisa mentioned the short-term, long-term divide. This was Mike Wilson on the short-term story. Bear in mind that this is a select quote, and when you read through the rest of the note from Mike, it's not exactly constructive on the future here. He thinks ultimately at the start of 2023, you do get to this situation where the earnings story doesn't look great and the market starts to roll over again. But him and the team are really leaning into this short-term, near-term, optimistic, constructive story. He said the following overnight. Week 3Q earnings hammered some of the biggest tech darlings, yet the S&P 500 and even the Nasdaq 100 ended the week up 4% and 2% respectively. He went on to say, our call is still for the rally to reach 4,000, maybe 4,150. We're leaning towards the upper bound of that. I want to get to Michael O'Rourke on it. Chief Market Strategist at Jones Trading. Mike, what do you make of that? Just the short-term and then the medium-term story. This short-term story that we can squeeze out this bear market rally a little bit further.
I mean, I think there's Mike Wilson has valid points. Obviously, he's been spot on the market, and he's had a really great call. But what we're seeing is an environment where, as you noted when you started the segment, the S&P 500 was up 4% last week amidst basically terrible earnings among the key players. And that's on top of almost 5% gain the week before. So you are seeing the short-term trading activity that I think is more technical and it's dynamic. And I think it's become kind of expected. I think throughout the first 3 quarters of the year, everyone knew the outlook was bad. Everyone was very cautious. Everyone was very patient. And I think as Q4 started, people wanted to put money to work. And I think that's what we're seeing here in October.
Is that a wave you want to carry on surfing? Because the S&P equal weight was up 5.5% last week. The Russell of small caps, Michael O'Rourke, the small caps were up 6% last week. Do you want to carry on chasing that?
No, I definitely do not. I'm the guy you probably bring on to scare people on Halloween. I think the environment's much different. The outlook going forward is much different than we've had for the past couple of decades, where it's been this benign inflation environment that really allowed central banks to have this easy monetary policy. And not to say we're going to super tight policy, but again, we're going to have the Fed funds rate at its highest level in 14 years this week. And we're looking at a 4% Fed funds rate with more hikes to come. Meanwhile, the average over the past 2 decades, it's averaged 1.28%. So it's an environment investors are not accustomed to. And I just don't think they're looking forward to 2023 and saying that's going to be a little more challenging, which I think what I'm saying kind of aligns, for different reasons, maybe aligns with what Mike Wilson's saying. It's just not going to be as great for earnings and for companies.
So let's talk short-term and long-term. Short-term, in other words, you can see whatever you potentially want to see in terms of a short-term bear market rally like Mike Wilson is saying. But Michael O'Rourke, what does this mean over the next 1, 2, 3 years with respect to stock market returns? Where do you differ from some of the others in the market right now that see us going back to a low inflationary, low rate regime?
So ever since the global financial crisis, we've had this negative real Fed funds rate environment, if you use the headline inflation or core inflation. And I think what the Fed is trying to get to is a positive real Fed funds rate using core inflation. So we're about 200 basis points away from there. So we need to do that through a combination of rate hikes and obviously inflation coming down, which is going to happen. So, but it's the type of situation where it's going to take time, and that's why we have this whole higher for longer mantra out there. I think the time horizons between the markets and the Fed and even the policy adjustments we've hit cross currents where the time horizons are different. Everyone's been negative on the market since the beginning of the year, so it's been 9 months. The Fed only really started tightening 6 months ago. Those tightening measures are only starting to take effect now, as we've noticed in earnings. Earnings last week was the first time it started really hitting home. So we still have this to play out over time. But investors are sitting there saying, we've been disciplined, we've been good all year. Maybe it's a time to buy stocks when, obviously we hit new lows a few weeks ago, and people just decide to buy the dip and are hoping for a rally into year end. And I think what you're going to see happen here is the rally is going to run its course, but then you're still looking at a situation where some very high profile companies had very disappointing earnings, and you're not going to see new money flowing into those names in a meaningful way beyond passive index flows.
Michael, this wasn't that scary. Happy Halloween, sir. Michael O'Rourke, Jones Trading. Michael, thank you. I think we're used to it after about 9 months of it now.
We didn't get into the
performance of this market.
We didn't get into the really scary stuff, though.
What's the really scary stuff?
Really scary stuff
What's
is what
really,
happens after that.
The
whole lost decade and stagflation.
Didn't we mention that a little bit earlier? Look, we've talked about pricing the bulk of the tightening cycle. We now need to discuss the consequences of the tightening cycle and just how much we've done in such a short amount of time. I bring up Fed funds on the chart on a Bloomberg sometimes just to go through it again and go through the previous tightening cycle, which was 225 basis points of tightening in 3 years. And we've done 300 basis points in 6 months so far this year.
What's been shocking me is how immunized this market is. I mean, if you take a look, for example, at corporate debt and how far they've pushed out the maturities of some of their debt, how much consumers really haven't taken on as much debt that is floating rate that they're going to have to adjust to. There's so many things that make it an economy that's not going to respond very quickly to Fed funds rates that are higher for a long time, which is why I keep going back to this idea of how long will the Fed hold those rates at that level. And that's where I think it's probably going to bite a bit more.
That's the most important point. And I've caught up with Lotfi Karui at Goldman on this. I've spoken to the team at Morgan Stanley about this. And they're basically suggesting the maturity wall isn't right here, but it is out there in the future. And the longer you keep rates here, the more problematic that starts to become. This year, arguably what you have seen is supply fall off a cliff when it comes to high yield, which has been supportive of what's happened with spreads. We've talked about the quality of the index really improving relative to where it was 5 years ago, which speaks to why spreads aren't wider than maybe people thought they would be. But the further you go with rates and the longer you keep them there, then you do start to have a conversation maybe in 12 months' time about a maturity wall being on the horizon. And that's not the story right now, but could be a story for 23.
Especially at the same time when that maturity cycle becomes a problem politically as well for the United States.
The sovereign issue.
Yes, exactly.
As well. Futures right now on the S&P down about 1/3 of 1% from New York City. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In Brazil, the results of the presidential election signal a change in direction for Latin America's largest economy. Luiz Inácio Lula da Silva was elected in a dramatic comeback for the left-wing politician. 3 years ago, he was in a jail cell on corruption charges. Lula narrowly defeated incumbent Jair Bolsonaro, who has neither conceded nor commented on the results. His reaction will be closely watched by investors. Today, there's a showdown at the U.S. Supreme Court over affirmative action. Justices will hear arguments on admissions policies at Harvard and the University of North Carolina. The schools are battling an interest group that wants to overturn precedents that let colleges consider race when they choose students. The CEO of Barclays says the lender's investment banking operation is critical to its success. CS Venkatakrishnan spoke to Bloomberg in his first television interview since taking the job a year ago.
The investment bank has been what has kept Barclays flourishing and quite apart from many of our competitors in the fact that, we performed extremely well during COVID. We were able to have a more diversified business model.
Last week, Credit Suisse confirmed it is looking to downsize its own troubled investment bank after multiple losses. And private equity firm Blackstone has agreed to buy control of Emerson Electric's climate technologies arm. The deal values the business at $14 billion. The business sells products like compressors that are used in heating and cooling equipment for offices and homes. Emerson will keep a minority stake. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Lisa Mateo. This is Bloomberg.
Chris, go.
After hardly a full year of name, image, and likeness deals being a reality, UCLA quarterback Chase Griffin already has more than 20 deals with major brands, venture, and charitable groups, all while balancing graduating undergrad in just 2 years and fighting for playing time on the field.
Chase Griffin out of the gun.
We are joined by UCLA quarterback Chase Griffin. Not just UCLA quarterback, but name, image, likeness superstar. I am psyched for this one.
This kid could actually be the president of the United States someday.
When it comes to building generational wealth, it's not about the money that you make in college. I'm very excited that I made the amount of money that I made last year. I am even 10 times more excited that I know how to make that money.
No one covers the world like Bloomberg.
Because Trussonomics is being dismantled, MPs behind the scenes are asking, what's the point of having her at the top?
Can the strong dollar amplify the world's risks of instability?
Xi Jinping said complete reunification must be realized.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
A lot of the satellites have propulsion systems. They can kind of move to get out of the way of each other or change their orbit a little bit. It's a service that you guys offer to help these companies know how to maneuver their machines.
Yeah, we offer a collision avoidance service. It's a subscription service. We'll send you an alert up to 7 days in advance if your satellite's going to come dangerously close to a piece of debris or another satellite.
Companies have been doing that for decades, moving satellites around, but it's sort of like a harder problem now.
The risk of a collision is a lot higher now, just because we've installed so much more hardware into space. You have a big collision, it creates a cloud of debris, and now all the other satellites are flying through this whizzing mess of debris. As we add all of the new satellites into space, the risks of the collision, the likelihood of the collision is going up.
Expecting prices to go towards $100 pretty into the year end and really trade into the 110s and 120s for most of next year. And the biggest upside, like you mentioned, is the winter. Of course, weather is always going to be erratic, and nobody can really predict weather.
And Rita Sen in the last hour of Energy Aspects on this program. Brent crude this morning, good morning to you, down by 1.1%, 94.72 on WTI 86.56, down by 1.5%. My good friend Manus Cranny standing by in Abu Dhabi now with a tremendous interview. Let's get straight over to him. Morning, Manus.
Jonathan, a very good morning to you. Yeah, that's a punchy old call from Rita Sen at 110, 120 bucks for the winter. Let's see whether Russell Hardy agrees with me. He's the CEO, not with me, but with Amrita, of Vitol. Good to have you with me, Russell. A busy ADIPEC. I'm looking at oil at 94 bucks, up 10% in the month. Talk to me about the real market. Is there a sign of demand destruction at any level here?
Oh, absolutely, absolutely. First, good afternoon, and yeah, it's a bit. There's plenty of people to talk about the oil market here, but I'll give you just a few thoughts. The supply side's obviously been constrained a little bit by OPEC. The supply side may well be a little bit constrained by the Russian sanctions in the future. The supply side is clearly at or close to its max. There's not a huge amount of spare capacity, so that creates a little bit of supply side tension and makes people a little bit worried. But on the flip side, on product demand, if we were doing this interview in January, I would have told you that we expected demand to be 2 million barrels a day higher now than it actually is. And why is that? That's the war, that's inflation, That's the price impact on consumers, and all of those, and of course the Chinese lockdown situation. So on the product side, you do see significantly lower demand, and obviously that's helping keep prices in balance.
Is the bar to demand destruction a lot lower now? We're talking about rates in the States at 5%. We've got jumbo hikes coming from Europe. We've got inflation at 10%. The bar to demand destruction, is it getting incrementally lower?
I think a lot of economies, a lot of emerging market economies, Q2 saw the highest prices. So if anything, certainly across Africa, we've seen a little bit of restocking when markets eased in September. I think it remains painful. It remains difficult for many countries, and so as a result, yeah, we're still going to continue to see that demand destruction, I think, for another few months.
Let me flip it to the other side. There's been just tiny moments of reprieve in the quarantine aspects for China. Tiny, very incremental, not fundamental. If there is a structural shift in China's reopening narrative from zero COVID, what does that do to demand structure and price for oil?
So, of course, I think everybody expects some improvement in mobility and movement in China some point during 2023. It's probably more likely the second half of 23 compared to the first half. But in the meantime, the Chinese economy, in terms of exports to Western markets, is feeling the other side of the coin of the high energy prices, because the consumer spending is reduced. So yes, we'd expect a resurgence in demand from China. Yes, we'd expect a resurgence in aviation demand, for instance, which is still a long way behind where it might otherwise be. But all of that's probably more likely in the second half of 23. And in the short term, we're still dealing with the reduced growth in damage from inflation and interest rates.
So the other dynamic is December the 5th, we get another set of sanctions. About 2 million barrels a day will flow away from Europe on the oil market. Descalzi, Claudio said to me this morning, that impact of that flow of supply into Europe, does that all just go to India and China?
I think it's difficult to say at this stage exactly where it's going to go, but it's likely to go east rather than west. There are some markets in the west that may be suitable for Russian products, but most of the crude, I would imagine, will follow the path of the existing crude, which is to Asia.
Part of your role at Vitol is to ship that. You're still shipping Russian crude.
No.
You're not.
No.
My apologies.
We announced in April that, or April or May, that we'd ceased shipping crude oil. We still do a little bit of products business, but it's not a significant volume or a significant contribution.
What shifts the dial in this market? Strong dollar, Fed on the move, China reopening. What is it that shifts the narrative in the oil market? Is it another cut from OPEC? Is that the biggest risk on the desk at the moment between now and Christmas?
I think the biggest risk is the one you just highlighted, which is how much of that Russian oil production makes its way to markets. There is a risk that Russian oil production in some way gets shut in Russia because of logistical constraints or issues around the price cap legislation or issues around the European sanctions. And so I think that's probably the biggest short-term risk. And lots of commentators have got a different view on it, anywhere between 500,000 barrels and 2 million barrels of possible supply loss as a result of just the difficulty in getting the product from A to C instead of B.
Just to close, we've got a lot of speculation about a price cap on gas in Europe. Is the politically poisonous truth that in Europe you need demand destruction and not price caps on gas to settle this market?
Yeah, I don't think the expectation was that the price cap would be at a moderate level. I think it's more about dealing with some of these runaway type of prices that we had in August. So in August, the futures market ran up to 343, totally unaffordable. Industry can't afford it, customers can't afford it, and so I think the EU's thinking about how they can prevent that kind of financial stress and strain occurring, in the wholesale market.
I'm going to squeeze you in 15 seconds. Where do you see the price of oil 23?
When in 23, it's going to be volatile.
It's going to be what?
It's going to be volatile. So one would expect. I mean, I feel it's a little bit soft at the moment, and a recovery is due next summer.
Okay. Russell, thank you very much for being with me. Those rounds of applause, Jonathan, were for squeezing another CEO to try and give me a price of oil between now and Christmas of next year. From a rowdy corridor, I've got the penthouse corridor suite here at ADIPEC. Everybody's
Lucky
here.
you. Lucky
Jonathan.
you. The applause is always for you, Manus. Thank you, sir. Manus Cranny there with Russell Hardy of Vitol. Vitol, just one of those institutions with a fantastic eye line into what's happening in the oil market. Demand destruction, a theme that came up in that interview, at least for a number of times.
It seems to be the one thing that many places are trying for, right? How do you encourage demand destruction at a time when you've got limited supplies? And how long is that going to be the theme?
Do you think that his view of what's happening in the oil market right now is pretty well aligned with what we heard from OPEC in the last month too?
I would guess so.
Basically.
I would guess that, yeah, they're pretty much in alliance.
Futures right now, down 0.4%. Not sure they'd like that word alliance, Bramo. On the S&P, we're a little bit softer. From New York, this is Bloomberg.
Apple's delaying its next major iPad software update, iPadOS 16, by about a month from September to October. Apple made the decision for a number of reasons, including a still buggy Stage Manager multitasking interface and in order to link the launch closer to the more similar macOS Ventura. Still, it's an unusual move. Since shifting the launches to the fall in 2011, Apple has released its new iPhone and iPad software updates simultaneously each year around September. By staggering the releases, users may find some issues around compatibility with cross-device features like retracting and editing messages in iMessage, the new shared iCloud photo library, and the new feature for transferring FaceTime calls between iPhones and iPads. It will also make it a bit harder for developers to launch apps that run on both the iPad and iPhone that require new APIs and features found across iPadOS 16 and iOS 16. Regardless, it was still, of course, the right move. Stage Manager on iPadOS 16 is still quite buggy. I don't find it particularly intuitive, and it's not compatible with most iPads and many third-party apps on the App Store. The feature clearly needs some more polish. And complaints from consumers about Stage Manager will now no longer probably overshadow the earlier launch of the iPhone 14.
Power, policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect. How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
That over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is going to be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Expectations right now are basically plus 3% earnings growth.
We do expect the Fed to maintain this aggressive pace into the end of the year.
As monetary policy goes deeper into restrictive space, each incremental hike is going to be more difficult to justify.
The one thing the Fed cannot afford to have anyone say is they're not credible.
Frankly, nobody knows what the market is or should do going forward, given the complexity of the new macro environment that we're in.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Actual tweet moments ago. Can Bramo do all her bear market bits today in a spooky voice whilst holding a flashlight under her chin? Surely today is the prime opportunity. Thank you, Jay Hardy, out on Twitter for that one. Can you? Let's get the torch and talk about how bad everything is right now.
Have you brought a flashlight or a torch?
I don't have a flashlight.
Well, then I can't do it. I'm sorry. It's not going to work. Maybe later.
Do you not call it a torch? I call it a torch.
We call it a flashlight.
Okay.
A torch is like burning. You throw it in and it's Hallows Eve. That's not really
Don't go that
okay.
far.
Good morning, good morning.
Do you want to do it? I can do it again if you want.
Okay, go ahead.
Good morning, good morning. After the tremendous rally we had last week, is there anything bearish to say? I have to say, I come away from last week just thinking how tremendously resilient this equity market was in the face of some terrible earnings we got from 4 major tech players.
I feel like a broken record, and I hate going back to this because it's really kind of not that interesting anymore. But people believe that if the Fed starts to slow the rate of increase of their rate hikes and that we are reaching peak inflation, as Mike Wilson thinks, that's going to give a lift to markets. Will it, right? I mean, this all goes down to some of the earnings that we've seen and whether they continue to deteriorate heading into next year.
And then what the Fed does beyond, say, November. November was always going to be about December. I've had a lot of pushback this morning against this step-down chat because how many times have we gone into a Fed meeting expecting the step-down this year and ended up with 75 and again 75 and again 75. And for whatever happens at this Federal Reserve meeting on Wednesday, in the following week, we'll get CPI in America. And I'd say let's go to the ECB for a playbook. If you want a playbook right now, never mind the RBA and the Bank of Canada, look what the ECB did. Open the door to a step-down. 2 days later, got CPI data, Friday out of Germany, France and Italy, Monday for the Eurozone close to 11%.
Which is a reason why I suspect that the likes of Bill Dudley are going to get more voice, even more voice. I mean, he's had a lot of voice, but he's been right. And how much can you start to see those end rates climb even higher? Because we've talked about this, right? The economy is not responding as quickly to these rate hikes, and inflation keeps surprising to the upside. So at what point can you imagine, okay, a slower pace, but getting to 5.5% even?
Slow stretch and raise. That's the approach that Evercore's looking for. Slow stretch and raise. Do you think that that's going to be the one that people go with?
No,
on Thursday morning.
Slow stretch and raise. It sounds like what we should do on Monday morning.
I get it. What they're saying is that basically if you do step down, throw another 25 basis point hike in there for next year, just to communicate that you're not giving up anytime soon. You're going to stick with it for a long time. Does that make sense?
My head is spinning.
Does that work for you?
Maybe that will give some sort of hawkish feel, but people don't believe that this Fed has conviction. And I go back to this discussion around, are the Fed's projections realistic? Do they have to say, we are going to see unemployment rise, people are going to lose their jobs, we don't like this, but it is a necessary condition in order to let inflation come down a bit more? If they say that, and then they say, okay, and we'll have a slower pace but a higher end point, maybe people will believe that.
Powell told us. Jackson Hole, Wyoming. So did the ECB. Chairman Powell talked about pain repeatedly. I keep going back to that speech just to reflect on it. You had the same thing as well from Isabel Schnabel of the ECB, who talked about a willingness to hike interest rates even into a recession, if that's what materializes. That's the playbook from these guys.
But the projections haven't reflected that.
Sure.
And that's a big deal. And not only that, but we haven't gotten the pain yet for them to respond to. And people say, yeah, right. When we actually start to get the people getting laid off, you start to get the political pressure, you start to get the stories of people who cannot afford the day-to-day costs, it's going to be a different story.
Wasn't that the whole point of the operational independence of central banks, that they weren't meant to be touched by the political cycle? that they were meant to make these hard calls. So why don't they make these forecasts? Why is it just the Bank of England the only one who's basically saying, you know what, I think we're going to have a recession?
Right now, they're damned if they do and damned if they don't. They're going to be political any way they cut it. Either they're going to make it harder for governments to borrow, or they're going to basically succumb to the political pressure of the incumbent party. Either way, they're in a terrible spot, and a lot of this is because the fiscal side has been really derelict with their duty to really invest in the real economy, like you've been saying.
Futures right now down about a half of 1%.
Getting off my soapbox
The
now.
S&P, that just needed the torch or the flashlight.
It's spooky, boys.
Futures down just a touch. Yields up just a touch. By a couple of basis points, call it 3 basis points higher on a 10-year, 4.0416% on a 10-year. We talked a lot about that upside surprise on CPI to Europe. The euro's weaker, euro-dollar negative a third of 1% at 99.32. Brammer, you've talked about it a few times this morning already. That data out of China overnight, the PMI's in the 40s, crude at 86.25. We're down by 1.9%.
And how much really is China the story behind crude? And how much does that really lead to the even more ambiguity of what happens next year when so much of this is driven by zero COVID?
We heard from China, from Vitol, rather, on China moments ago with Manus Cranny, unlikely to see demand rebound in the second half of 23. Is that good or bad? If you're in the United States right now, is that good or bad?
It's good in terms of not necessarily leading to an oil price spike. It's bad when it comes to the prospect of some of the supply chain disruptions that have allowed prices to remain high in other areas of the economy, because it is hard to see how those really ease up with these still constraints in China.
Sourcing you a flashlight right now. We're going to make it happen. Lisa Hornby.
If you get me one, I will do it.
Is standing by, the head of US multi-sector fixed income at Schroders. Lisa, the Federal Reserve on Wednesday, all this chat about a step down. What are you and the team thinking about when you go into this November meeting?
Well, I don't see any reason for them to commit to downshifting on Wednesday. I think that they will let us know that they're considering it. But we have, as you said, John, 2 CPI prints between Wednesday and the December meeting. So what's the point in saying, here's what we're going to do, it's time to downshift? I think they're going to say, hey, look, if we see inflation moderating to some degree, we're open to it. We realize we've hiked a lot. It's going to take some time for this policy, this tighter policy to actually have an effect. But as you said, the central banks have been wrong before, and they've said they're going to back off a bit, and then they end up having to kind of go full throttle. So I just don't see why they pre-commit quite yet. They don't have much to point to in the way of inflation moderating here.
In the meantime, people are looking long-term, and they're trying to get a better sense of long-term, since short-term is so difficult to project. And Brian Weinstein of Morgan Stanley earlier this morning saying that he likes long-dated treasuries because regardless of what they're going to do, it's going to slow growth and slow inflation over the longer term to make 4% yield on a 10-year treasury attractive. Do you agree?
I think there's a lot of merit to that. I think it depends on your time horizon. If you're a long-term investor now, certainly. Will you have a better entry point tactically between now and the next 6 months? Probably. But again, it depends on your time horizon on this.
Nice feature over the weekend in the Wall Street Journal. I think they had about 5 or 6 investors being interviewed about 2023 and the opportunities. This jumped out from Rick Reeder, Bramo. He said, I'm more excited going into 2023 than I've been in a really long time. You hear that a lot from the fixed income team, don't you?
Yeah, a lot.
You hear that a lot. I really do.
Okay, I hear that also because I lived through the era of people railing against zero rates, complaining. We're not getting anything. This is ridiculous. It doesn't make any sense. Now they're getting 9% average yields on things that actually look better because these companies have preserved cash.
For those people who've been sitting in cash complaining about low rates, I haven't heard enough from them about saying, yes, we're going to take some opportunities here. Lisa, does that resonate with you, what Rick Reeder said over the weekend? I'm more excited going into 2023 than I've been in a really long time.
It absolutely does. I mean, that was basically the title of our market paper as well. And, it's to Lisa's point, you don't even need to go to high yield to get interesting yields. I mean, HSBC came with a bond deal last week, north of 7%. It's a 4-year piece of paper. I mean, I think you're going to be paid. You're going to be well compensated for that. Again, time horizon matters, but over the next 4 years, 28% return. I think that's going to be a good investment. And you're just sticking in the investment grade market there.
Lisa, how has business changed then? Can you walk us through that just over the last 6 months? Do you get the sense that people see the world the way you see the world in fixed income going into next year? There's more interest from people that would typically be allocated to equities or somewhere else?
Yeah, I absolutely do. So I've been to presented at a few conferences, and the interest in fixed income now is much higher. It's palpable. People are excited about it. I think there's still a little bit of nerves, right? It feels a bit like catching a falling knife here, and so there's a bit of a, we want to allocate, but not quite yet. So I do feel like there's the risk, and we've had this a couple of times this year, where you get a bit of a rally, and then all of a sudden you get a lurch, even tighter, because everybody thinks, oh, this is it. We passed the peak. We need to get in, and then it's been past the last year, it's been kind of false starts. But I do think that could be the template. Everybody is sort of waiting, sitting on their hands a bit, but they want to get invested, but we're not quite there yet. So when we do, it could be fairly sharp. But I think there's a lot of interest. I mean, when you compare fixed income to private markets, when you compare them to other public markets, I mean, fixed income has corrected a lot. I mean, it's my
Just
favorite
massive.
stat right now is it's credit of Deutsche Bank, but they basically have the Treasury index going back to 1788, and I believe this was the worst return since that period. So it just gives you some context for, we use the word unprecedented a lot in markets, but I think that's truly unprecedented.
Truly is. Lisa, thank you. Lisa Hornby there.
Thank you.
Schroders, thank you very much. I just hear that so many times, Bramo, at the moment, so many times when it comes to fixed income.
Well, just to put this into perspective, when she's talking about an unprecedented decline, I just looked at the Bloomberg U.S. Corporate Total Return Index.
Sure.
It's down more than 19% so far this year. That is the worst year on record, if it continues at this level, going back in records to the 1973. So to give you a sense of just how much pain has been absorbed into this market, people are now saying, okay, it's taken a lot. We kind of like this. A bit the sort of hesitance to her, which is really amusing.
It sounds like you're hesitant to say it as well. I'll say this is not a judgment about what we can achieve or where we're going, more an observation. There is some good news if we can, actually settle down. I just think if risk-free can end up at 4%, it just changes markets completely. In a positive way. It brings discipline back. You stop this nonsense in equities.
I would agree.
This is what people have been complaining about for a decade.
You got it.
Plus.
Here you go.
Bramo, what do you write about if that's the case now? 10 years of columns.
I don't know. It's a good question. I just have to be like, you've said I've looked more constructive recently. Well, this is the reason why.
You've certainly changed. There's no flashlight or torch, whatever you guys call it.
All right.
Greg Valliere is going to join us shortly at AGF.
Hopefully.
This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In Brazil, it's a dramatic comeback for former President Luiz Inácio Lula da Silva. The left-wing politician has won the presidential election, narrowly defeating incumbent Jair Bolsonaro. 3 years ago, Lula was in a jail cell on corruption charges. Bolsonaro has neither conceded the race nor commented on the results. His reaction will be closely watched by investors. Ships loaded with grain are sailing from Ukraine, despite Russia's announcement that it was withdrawing from an agreement to keep seaborne exports flowing. Both the United Nations and Turkey are working to salvage the deal. Ukraine is one of the world's biggest suppliers of wheat, corn, and vegetable oil. Meanwhile, Russia launched a massive wave of missile attacks across Ukraine. The capital, Kyiv, was one of the cities that was hit. In South Korea, the government has opened an investigation into one of the country's deadliest incidents in years. At least 154 people were killed when a crowd squeezed into a narrow alley during Halloween festivities. Reports are that some people began to fall, causing others to tumble and pile onto one another. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts. I'm Lisa Mateo. This is Bloomberg.
flowers are made of 92,000 solar panels. Laid on the surface of a reservoir, they can generate 41 megawatts, which is enough to power 20,000 homes. It's one of the biggest floating solar plants in the world. Floating solar arrays have been gaining traction in Asia, including countries like Singapore and Thailand. Floating projects typically benefit from an easier connection to the power grid. They can also restrict algae blooms while keeping the solar panels cool. This one in particular has helped the local economy. When the power plant was first proposed, residents were given the chance to invest. Some locals were also offered jobs during construction. In fact, it was the community that requested the panels to be shaped as flowers to look more appealing. South Korea still relies heavily on imported fossil fuels, but will need to change that to reach its goal of becoming carbon neutral by 2050. Solar plants like this one may help the country reach its net zero goals.
Part of what I love about business is you get to build things from nothing.
I don't have any investors. This is all money in. This is me just building it.
It's pretty much full service shadow banking with nobody in charge.
From New York City.
We're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
How
story.
are you thinking about those dynamics?
Lots happening on Wall Street.
I think Jay Powell said things that were indefensible.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights
We think that's the next secular shift.
from business's most influential and instrumental.
It's knocking it out of the ballpark.
It's a challenging dynamic.
This is a level of uncertainty that we haven't had to deal with.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio. Markets expect another rate hike.
Investors obviously skittish.
What the Fed do on November 2nd is key to everything.
But where will the Fed go from there?
No sign it is ready to stop tightening.
Everybody talking about a step down.
They're going to wimp out and they're going to blink.
Trust Bloomberg for the fastest coverage and exclusive analysis.
Do we want this Fed to force a recession?
The Fed's going to torpedo momentum.
In markets like this, everyone's a long-term investor.
Bloomberg Surveillance. The Fed decides. Wednesday on Bloomberg, your global business authority.
Right now, as you know, in the Senate, it's a 50-50 tie. In the House, Democrats have a very small majority. The vote right here in this district could determine which party controls the U.S. House of Representatives.
This is serious stuff, of course, a week away from the midterms, but at the back of this studio, it's all dark. There's not much lighting, and all I can see right now is a floor manager in a skeleton onesie.
Yeah.
I'm not sure even that the cameraman can pick up Joel wearing that.
Let's see if we can see.
Can we pick that up?
Can we do this?
Maybe we
Joel?
can pick that up. Just about. Just
That's
about.
fantastic.
Joel, I can't even see your head.
I know.
Just see the outline of a skeleton onesie. Anyway.
Happy Halloween.
Did you find that flashlight, that torch?
No, I didn't, and you didn't bring me
to
one.
do bearish pieces. Do
I-
you know how good that would work on digital? Just like weekly moments with Bramo. Bramo's World, 60-second clips of you just in a dark room with a torch.
Yeah, exactly.
Just telling everyone how bad things are going to be.
Really? Are we doing this? Are we doing this?
No, I can do the
all
markets
right.
as well if you want.
Let's do the markets.
Futures
I
down
think
a
that
half of
might be
1% on the S&P. Is Happy Halloween a thing? Did you say that to people?
Yes, that's what you say.
Happy Halloween?
Yes.
Okay.
Just try to enjoy it.
Like year 7. I think
not
it's like
really
year
been
7
trying.
going into year 8 or something of being here, and I'm still trying to work this out. Yields up a couple of basis points, up 2 basis points to just north of 4% in the FX market. Euro dollar down a third of 1%, 99.30. I just think bonfire night in the UK is more controversial, that we teach kids that it's okay to to burn historical figures on a stake. I think that's bizarre.
Well,
I find that really bizarre.
Here you just
Guy Fawkes night. I find that just ridiculous.
I couldn't disagree. I think it's also, in the U.S., you just, dress up like them.
Dress
and
up
walk
like
around and
skeletons and whatever you want.
Public figures.
As public figures?
Yeah.
Did you see at Spirit Halloween you can get, like, Federal Reserve figures now, Chairman Powell? You can put an order in for Lagarde and Bailey.
All right, you want to do that?
I was going to sort that out. I don't know if you can actually do that at Spirit Halloween or not. Greg Valliere joins us now, Chief US Policy Strategist at HF Investments. Greg, let's talk about energy, and that's been a big problem for this White House through this year. How is that playing in the midterms? The lack of a coherent energy strategy in the minds of so many people, Greg?
I think it's playing really poorly. A great editorial in the Wall Street Journal, I think it was this morning, all the days start to blur, but talking about how dysfunctional this energy policy has been. I mean, Joe Biden is complaining about prices, but in reality, one of the reasons prices have gone up is because of his policies.
Wait, can you elaborate on that, Greg? Because a lot of people think that his policies have been to unleash the SPR on the energy market, on the gasoline market, and that's brought down prices. What's the other side of the story?
Well, the other side, Lisa, I think, is how adversarial the White House has been, starting within days of his inauguration when he killed the Keystone Pipeline. And then he's gone from there, really beating on fossil fuels, coal, oil, natural gas, and saying that renewables is the way to go. I think renewables will play a major role for the rest of this decade. But right now, we need fossil fuels.
Okay, so that's the case. At the same time, perhaps it's just the coherence in the message from this administration, because they have actually confirmed that kind of view and said we need to encourage investment by some of the oil majors. Where could they be more consistent, right? What could be the message that could read through better that perhaps the Republicans are giving, in your view?
Well, I'd say probably regulatory policy, which has been quite restrictive. I think the industry senses a regulatory policy that's quite harsh, and therefore the industry is not doing much drilling or refining or shipping.
Greg, if they can keep hold of the House and the Senate, what do you think this administration would like to do next? What do you expect to happen?
Yeah, it's a good question, John. I think that because both sides are so bitterly divided, we have to lower our expectations for much. But I do think there's a chance they'll talk about immigration. Everywhere I go around the country, I hear the same refrain. We don't have enough cooks, waiters, waitresses, carpenters, whatever. And I do think more legal immigration is really would be very beneficial. And I think both parties might agree on that.
Greg, in the meantime, a lot of people are thinking that it's going to be gridlock, and markets like gridlock, and that seems to be the feeling right now. Is this going to be gridlock that's good for markets?
Yeah, I think so. I think that there's not going to be anything radical, certainly nothing new on taxes, capital gains, the estate tax, the top rate. I think all of that stuff gets frozen for at least 2 more years, and that kind of predictability is a good story for the markets.
What does that do to our alliances with other nations? And I think about some of the potential for restricted exports of natural gas, of diesel, especially in light of some of the up in price that we've seen recently in both of those categories. How much could that really create some long-standing fissures in classic alliances?
It could. You can't rule it out. I would say, though, the biggest fear that I would have in terms of fissures is Ukraine policy. We're starting to see a lot of ads on TV in the last couple of weeks talking about why are we spending this kind of money on Ukraine? We got problems right here. If there starts to become a perception in Western Europe and in Russia and Ukraine that the U.S. is losing some of its resolve on Ukraine, that's a big deal and a very negative story.
Well, Greg, the prospect of any kind of trade restrictions on energy products out of the United States would only exacerbate that in places like Europe. Yep. Greg, that trial balloon has been floated a few times this year. They haven't gone forward with it. Is that what's holding them back? I guess it is. What would push them forward? What would make them go through with a policy like that?
Well, I think what would push them forward would be a sense of the U.S. economy is starting to weaken sharply. I don't see it yet. The data looks pretty good. But if at some point next year the U.S. economy is starting to slump, then I think there'll be a serious debate over how much we're doing for Ukraine. And the Republicans may lead a fight to give them a lot less.
Hey, Greg, thank you. Appreciate your time. Greg, no doubt we'll catch up before next week. Greg Valliere there of AGF Investments. Bramo, if they go forward with that, can you imagine how controversial that would be?
Oh, it would be massive. I mean, can you imagine any kind of trust between the United Kingdom, between the European Union and the United States if the United States says, look, well, we're facing pretty high prices too, and it's not expedient politically, so we're not going to export to you, even though you might be struggling with that. That's not going to fly. But, oh yeah, keep the Ukrainian policy as it is. And that's why I wonder if Vladimir Putin and the Western nations are in a race right now for how quickly the pain can hurt the other more than themselves to get some sort of win.
This White House has done a good job of keeping its allies on side, speaking from the same script. Every single country across Europe doing the same thing, with the exception of maybe places like Hungary. But for the most part, they've done a pretty good job of doing that. If they went forward with something as divisive as that, I just think that changes everything, doesn't it? And that's probably why they've held back from doing it.
It would be a game changer, not just with Russia, but also with China, because what kind of alliance can you have if you don't back your allies from an economic perspective? That's going to be a major issue.
That skeleton's getting closer.
He's wrapping
close,
us.
Joe. It's just
He's
in the corner of my eye.
Be quiet.
The corner of my eye just like gets a break. Futures down 0.5%. Going to
look
break.
like me.
This is Bloomberg.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become chief future officers. Duke Energy has an ambitious plan to transition to clean energy, and new CFO Brian Savoy is ready to lead the charge.
We're going to invest $145 billion over a decade. There's a lot going on, but I wouldn't have it any other way.
Watch Chief Future Officer Wednesday on Bloomberg.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Welcome to the world of decentralized finance. Bloomberg's covering all things crypto, the people, the transactions, and the technology. Bloomberg Crypto, Tuesdays. No one covers the world like Bloomberg.
Because Trustonomics is being dismantled, MPs behind the scenes are asking, what's the point of having her at the top?
Can the strong dollar amplify the world's risks of instability?
Xi Jinping said complete reunification must be realized.
With unmatched reach and resources from more than 120 countries, the moment news breaks 24 hours a day. Bloomberg, your global business authority.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
60 minutes away from the opening bell, equities looking like this after a really decent week of gains on the S&P 500, despite the fact we had some pretty terrible earnings from some of tech's major players. Futures down by 0.5% on the S&P, down by about 21 points. Yields higher by 3 or 4 basis points on a 10-year, just north of 4%, 4.0499. You can call that 4.05 if you like. Euro dollar 99.26. We are negative 0.4%. CPI data out of the Eurozone earlier, 10.7%. Ugly stuff. Cruise down 2%, $86.13. We had the PMIs out of Europe last week in the 40s, out of China coming into this week in the 40s. PMIs in America, S&P global PMIs often get ignored. We look to the ISM, so the ISM comes out tomorrow, Bramo. You wonder whether that confirms some of the doom and gloom you see in Europe and, for that matter, in China as well.
Yeah, and if you don't see that, how much is that going to become a problem for some of these central banks that are going to keep hiking into that? I'm a little distracted right now because I'm looking at some of these headlines regarding OPEC's latest report, and this is the thing. Demand is going to keep increasing. That's what they're saying. And this is sort of the cudgel with some of the transition that people are talking about that we were just talking about with Greg Valliere. How do you offset the need for oil now and in the next 5 years, et cetera, when you don't have oil majors willing to really invest and you don't have policies that really want to support that given the transition?
The transition away from oil is, quote, potentially dangerous. That's their line. We've heard that a lot this year.
So how much is this politically pushing towards some of the fossil fuel companies? How much is this revenge of the real economy? And how much is this that we have to bridge the gap between now and then is a little further off than some people thought, then being a future where you can really rely much more on renewable energies and not as much on fossil fuels?
I mentioned that quote from Prince Abdulaziz bin Salman at the investor conference in Riyadh last week. And of course, the irony, when I read this quote, the irony won't be lost on any of you, I'm sure. People are depleting their emergency stocks, used it as a mechanism to manipulate markets, while its profound purpose was to mitigate shortage of supply. I said this earlier, but I'll say it again if you're just tuning in. There's 2 points there. One on manipulating markets. I'm sure you've got your own view on OPEC manipulating markets. But the second point, Lisa, the purpose of some of these inventories, like the stockpiles over at the SPR, the purpose was to mitigate a shortage of supply. Have we seen an emergency in the oil market? I remember asking this question to Francisco Blanchard, Bank of America, a number of weeks ago, who basically said, no, we haven't had a crisis in the oil market yet. And if we do have one next year, we're a whole lot more vulnerable potentially now because of what we've done this year.
And that's what a lot of people are saying. And I think that everyone pretty much is in agreement here that this was for the express purpose of bringing down prices and not because there was an actual shortage of people not being able to get gasoline into their cars.
It just make me smile when someone from OPEC talks about manipulating markets, though. I mean, like,
it's a little rich.
Come on. Vincent Reinhardt joins us now, Chief Economist at Dreyfus and Mellon. Vincent, fantastic to catch up with you, sir. Federal Reserve decision on Wednesday. I'm sure you're frustrated by the conversation at the moment, but you know the conversation of the moment. It's about this step down at interest rate hikes. How you expected the chairman to navigate these conversations in the news conference?
So if he, first they'll deliver 75 basis points because that's what they've said and they haven't said anything different. With regard to the hard part, 5th December and 2023, he doesn't really have to say much. They don't have a summary of economic projections dot plot this meeting. The last one said thered be a cumulative 125 basis point tightening over the last 2 meetings of the year. If they do 75 basis points on Wednesday, everybody will do the math, and that says 50 basis points in December. That's the step down. And even the language of the FOMC statement is consistent with an outsized move, i.e. something bigger than 25. 50 is bigger than 25. So his safest bet is to keep it pretty low key. Steady on course, because on course is 75, then 50, and then talk about 2023 and 2023.
Stocks are up almost 9% on the S&P in October. Of course, that's just one input into broader financial conditions. But Vincent, do you think we've seen a sufficient easing of financial conditions that requires some kind of direct response from this chairman to lean back into that?
This is a mini replay of July and August running up into Jackson Hole, where equity investors in particular got ahead of themselves, thought there would be a virtuous decline in inflation. If there was a recession, it would be painless, and that the Fed wouldn't raise rates very much and turn them around really quickly. Jackson Hole disabused the market participants of that notion. I think Jay Powell will have to do a little bit of that at this meeting, but really it will be in December with a new summary of economic projections. I think the message for them to convey is the same in Jackson Hole and the same they've been repeating. They're going to raise the funds rate. They understand it involves pain, and they're going to keep it there for a while. It's the plateauing that really will convey the important message. They got to get the funds rate into an area which they're confident that it involves policy restraint, and then it's a matter of holding it for long enough. Once equity investors get that message, you won't see the easing of financial conditions of the last week.
Vincent, in the meantime, you have this point in your notes that's really scary to me, to be completely honest. You write, tightening of the monetary stance abroad and the weakening global economic outlook is why we think the FOMC will stop short of firming enough to return inflation to the goal within the next 2 years. Are you basically saying that we are bound to be stuck with much higher inflation for longer because the Fed is worried about breaking something not just in the U.S., but globally?
Up to now, we've been talking about 2022. I think that's the discussion for late 2023 into 2024. And my basic concern is everybody knows what to do about monetary policy when inflation is so high. That's why there's not a lot of doubt about what the ECB will do later in the week. 2 digits on your inflation rate is a bad look. When inflation is this high, when you're that far above goal, you know you got to firm. However, next year inflation will be lower, the unemployment rate will be higher, our major trading partners will be in recession, and the Federal Reserve officials will have a much harder time balancing across their dual objectives, maximum employment and stable prices. And the temptation to reverse course will be pretty compelling. And besides, if inflation's falling and they have a forecast that more plausibly implies inflation getting down to a round goal in a year or 2 or 3, might they not stop short? Paul Volcker got cold feet the first time round, remember that. Paul Volcker stopped short of 2%.
Well, but
the second time round.
But Vincent, does this mean that we're going to be doomed to that stop, start that Mohamed El-Erian is talking about, that's going to leave us with a decade of inflation that will not get back down to 2%?
So 2 points. One is we got an old look for monetary policy now, right? The Fed is talking about outcome-based, not outlook-based policy. They're responding to events, not trying to lead them. This isn't forward-looking monetary policy. Well, that sounds 1970-ish already. The second part is, yeah, I think inflation will prevail above Fed goal. I don't think that far above goal. We are not talking about 5 or 6 or 7% inflation in 2024. It's rather something that's in the low 3s and the high 2s, something that the Fed could plausibly say, well, we're only one recession away from price stability. Let's opportunistically wait for disinflation down the road. Bad for fixed income investors, bad for markets. If 2% is your goal, you should get there. They're just going to say, let's take our time getting there.
That makes it sound very simple when you put it like that, don't you? We're just one recession away from price stability.
It doesn't sound simple at all.
Makes it sound easy.
It's also painful because there are people involved in those, by the way.
In a massive way. That is the painful point at the moment. Vincent, thank you. Vincent Reinhardt there of Dreyfus and Mellon, as always, just absolutely brilliant. And we've gone back and forth on this through this morning and many times over the last couple of months. I still think that's the major challenge in the news conference. You're doing this within a week of the midterms, and you've got the Democrats pushing back, and some of the points they're making are spot on. We haven't seen a sufficient explanation from this particular institution to suggest as to why higher unemployment is a price worth paying to get inflation down. And I keep going back to that question. I think they've acknowledged it in their forecast that unemployment needs to go up to get inflation back down. They haven't communicated why that is a price worth paying.
Except that you are seeing wage gains. We saw that on Friday with the employment cost index, and you keep seeing that, and they're saying, how do we get wages to stop rising so quickly, which also is a difficult thing to really pass through. If you talk about the fact that those wages are not keeping pace with the cost of living, you're correct. This is a difficult moment. They're relying on history at a time when history perhaps is not the best guide for a now new inflationary environment in the face of global conflict and deglobalization. This is new.
Are you coming to my Halloween party later?
Oh, it's going to be a rich
Tom's hosting.
Oh, yeah, is that right? What's he going?
He's been decorating the living room at our place.
Yeah, at your place that you share together?
Yeah.
Okay, that sounds like also very close to the truth.
Yeah. No, at our place.
What's your favorite kind of candy?
My favorite candy? You think I eat candy? Come on.
Sounds like a great Halloween party. That's all I can say.
Everyone's having protein shakes.
Oh, that's great.
And egg white omelets.
Oh, egg white omelets for
white
Halloween.
omelets.
You just basically, the kids come to your door.
You see
and
me
they just
celebrating
scream.
Halloween.
No, not in the slightest. That's why I'm saying.
Give me a...
candy. Can you imagine?
Aaron Kennan, co-founder and CEO
Egg white omelets. Are you
Clear
that
Harbor
person?
Asset Management. Yes.
And when people knock on your door, do you hand them an apple?
Slice the fruit.
Oh, for God's sake.
Slice the fruit.
You're that guy.
As our producer just said, nature's candy.
Oh, dear Lord.
From New York City.
You're going to get hate mail.
This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. In Brazil, the results of the presidential election signal a change in direction for Latin America's largest economy. Luiz Inácio Lula da Silva was elected in a dramatic comeback for the left-wing politician. 3 years ago, he was in a jail cell on corruption charges. Lula narrowly defeated incumbent Jair Bolsonaro, who has neither conceded nor commented on the results. His reaction will be closely watched by investors. Today, there's a showdown at the U.S. Supreme Court over affirmative action. Justices will hear arguments on admissions policies at Harvard and the University of North Carolina. The schools are battling an interest group that wants to overturn precedents that let colleges consider race when they choose students. The CEO of Barclays says the lender's investment banking operation is critical to its success. C.S. Venkatakrishnan, he spoke with Bloomberg in his first television interview since taking the job a year ago.
The investment bank has been what has kept Barclays flourishing and quite apart from many of our competitors. In the fact that, we performed extremely well during COVID. We are able to have a more diversified business model.
Last week, Credit Suisse confirmed it is looking to downsize its own troubled investment bank after multiple losses. And more headwinds for the economy in the UK. British consumers and businesses have cut back on borrowing after a jump in interest rates. According to the Bank of England, new mortgage approvals fell 10% last month. That's the sharpest pace since February of 2021. Credit card borrowing and loans taken out by businesses also declined. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
about cryptocurrencies? Are you a believer in cryptocurrencies?
No, I'm not a believer in cryptocurrencies, and I would say that cryptocurrencies are a bubble. And I would describe cryptocurrencies as a limited supply of nothing. So to the extent there's more demand than the limited supply, the price would go up. But to the extent the demand falls, then the price would go down. There's no intrinsic value to any of the cryptocurrencies, except that there's a limited amount.
Well, based on what you've just said, why would you not put a big short of some type on cryptocurrencies? Or maybe you have, but do you think that's a good short?
Well, you know, when we look for these subprime, the reason why we shorted these subprime in size because it was asymmetrical. You're shorting a bond at par that has a limited duration that trades at a 1% spread of treasury, so you can't lose more than the spread in the duration. Yet if it defaults, you can make the par amount. In crypto, there's unlimited downside. So even though I could be right over the long term, in the short term, as the case of Bitcoin, you know, went from 5,000 to 45,000, you know, I would be wiped out on the short side. So it's just too volatile to short.
Hydrogen has a very special place in the universe. It's the first element on the periodic table. It is the most abundant element in the universe. And when clean energy advocates think about what can we find which would be as easy to use as fossil fuels, they think about hydrogen. The fuel that will, when burned, only produce water.
We like to imagine that if we just built enough of these and these, we could ditch fossil fuels and save the planet. Unfortunately, it's not that simple. There are some things where you just need a good old-fashioned combustible fuel. Now, startups around the world are betting that hydrogen can become the fuel of the 21st century.
Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
What we're seeing in terms of the dollar is a unprecedented run and scarcity. And scarcity becomes problematic when we think about what's going on in Europe, in Japan. And I think that's going to be a big story.
That was Ian Lingen, head of U.S. rate strategy at BMO Capital Markets. You know, we are talking about Halloween today, and one viewer had this comment, inflation humor on a day of Halloween, suggesting that I dress up as transitory inflation, arrive at the party as inflation, and then proceed to leave early or simply stay and refuse to go. Anyway, we will get into that. Right now, we are looking at markets that are a little bit off after last week's gains, although nothing pretty dramatic considering the declines that we saw with respect to big tech. The S&P down about 0.6%, 38.89. I do think it's interesting to see euro weakness on the heels of an inflation report surprising to the upside. What happens to the euro if you do get an ECB that continues to tighten rates? Is that good or is that bad for a euro? Right now, this is very much politics season, not only in the United States, but around the world. We have elections going on globally, including just in Brazil, a pivotal election at a time of a populist, Bolsonaro, with a rival and former politician, former head of the country, Lula, who actually did come to power. Bloomberg Sirian has been in Sao Paulo covering all of this, and Damian Sassower, who always covers all things emerging markets here for Bloomberg Intelligence, here with us as well. Sherry, I want to start with you to talk about the emotion, the importance of Lula's victory, and how controversial it has been in the aftermath, given how close the victory was.
It's really been a historic comeback for this politician, two-term president in the 2000s, now back in power, incoming president Luis Inácio Lula da Silva. We still have yet to hear from incumbent President Bolsonaro. And of course, this was the narrowest margin of victory in a presidential election in Brazil in 40 years since Brazil returned to democracy. So we are expecting to hear from Bolsonaro at some point. We heard that his presidential convoy left his residential palace in Brasilia earlier today, but he refused to make any comments. The question right now for everyone, including investors, of course, will he concede defeat? Several times in the past is cast doubt on electoral authority, so there were fears that he might not go quietly.
How much social disruption, Sherry, has there been on the heels of this, considering that Bolsonaro was talking about he'd either win, he'd die or get jailed, and those are basically the only options in the post-election aftermath?
Yeah, we have seen, of course, what has been, I haven't really heard your question very well because there has been interference, but I'm assuming you're talking about the post-election results, what happens next. And this is what we're gathering right now. Perhaps not a lot of violence out there. We saw a little bit of violent incidents during the campaign, especially from Bolsonaro's allies that actually hurt his chances. Bolsonaro's polls were actually down this week when we saw more of those incidents. But perhaps there is a little bit more optimism and relief in the markets as well, given that we haven't seen any big instances of violence during the election count. Last night, we were out on the iconic Avenida Paulista, and it was a lot of joy and excitement by Lula supporters, expecting really new hope, new optimism for the country. Markets still down. The Brazilian real was down about 1.9% paired back. Those declines against the U.S. dollar. Stock futures are also down, but still not a huge negative reaction. In fact, Brazilian-related assets in Asia traded in the positive.
Thank you so much, Sherry-Ann, down in Sao Paulo. Damian Sassower here with us as well, and I'm curious from your perspective the importance of this, both from the market's perspective, after the real actually has surged, I believe, the most of any currency so far this year versus the dollar, but also from a larger political takeaway for the emerging market complex.
Well, I think you hit on the right point. I mean, the real is up 5.3% year to date. It's one of only three major emerging and developed market currencies that are up versus the dollar this year. What it means is that Brazilian government bonds have had a fantastic year. They're up double digits. The only other emerging market, forget about it, developed and emerging market, local government debt market that's up year to date is that of Turkey. So that just tells you everything you really need to know. But what we're waiting for here is obviously Bolsonaro. I mean, but the fact that the prosecutor general and the president of the Senate have already come out and validated Lula's win, as well as the presidents of the United States, Canada, and I believe Norway, it says a lot. And I think Bolsonaro's silence is deafening on that front. We're waiting to see his cabinet selections. We're waiting to see Henrique Meirelles, whether or not he's the former BCB governor, he's the former president and chief operating officer of Bank Boston here in the U.S. through the 80s. He's the pick that most are expecting that would be good for markets.
A lot of people are looking to the Lula win as something of stability, of going back to the complex of a world order that's sort of a throwback and not the populist kind of let's go it alone and prioritize the economy over the rainforest or other things. I'm curious from your perspective whether the tighter interest rate sensitive market is actually pushing people away from some of the more populist views that were fueled by freer money.
Yeah, well, I think it's the structural logistics of the judicial system, the Brazilian presidential executive judicial system right now. Just the fact that it's a divided Congress. You know, Geraldo Alckmin, who's Lula's running mate, lost in the election to Bolsonaro. He's right down the middle. He's right down the center, and he's going to have to govern from the center in order to bring the country together, bring the economy together. I mean, if you look at the results, it's basically the North versus the South, right? The southern regions have all voted in favor of Bolsonaro. I'm talking Sao Paulo, I'm talking Rio de Janeiro, and the whole Northeast has voted in favor of the Workers' Party, in favor of Lula. So it's a very divided country right now, and it's going to be very difficult to govern and to kind of impose some of his policies on the climate, deforestation in the Amazon, for example, on women rights, on LGBTQ rights, on just to kind of go back after 700,000 deaths during the virus. That's basically what happened in Brazil, just a massive amount. And the handling by Bolsonaro of the virus is something that resonates in a lot of people's minds.
Sherian, who's doing tremendous work down in Sao Paulo, talked a little bit about the fears of social unrest, of some of the potential violence. How do you look towards some of the social unrest that we've seen, or the potential for it in certain regions, and parlay that into a market view, parlay that into understanding the impact that it will have on the economy?
Well, you look at the populist pivot throughout LATAM, Peru, Chile. You know, they've obviously gone more in the direction of what Brazil's doing right now, just electing a populist president into power, but they haven't really been able to govern from a populist perspective yet. Most of those countries, because of everything you're saying, because of the world, the macro risk, the structural kind of what's going on in each country. And I think Brazil's going to be confronted with much the same thing. You know, a lot of their markets are going to be dictated by the Fed, by the United States government, by what happens here in terms of inflation and abroad. And I think you're seeing that in terms of swap rates this morning. Swap rates are a bit wider just to account for the increased sovereign risk. But by and large, the market is expecting some really significant rate cuts as you move forward into 2023, along with Chile and the rest of the world, because look, things are getting tight there, and economic activity is deteriorating quite considerably.
And they front-loaded it. How high are the rates right now?
Oh my God, 13 and change, I think, 13.75.
There you go.
Yeah.
It's a far cry from the, 3 and change that we have right now.
Yeah.
Damian Sassower, thank you so much, as always, for the context at a pivotal moment for Brazil. And people are taking some large messages from this as we go around the world to a whole host of other elections as well. Coming up on Balance of Power on Bloomberg TV and radio, Austin Goolsbee, strategic partner and 32 Advisors and former chair of the Council of Economic Advisors. That is coming up. Looking at the markets, you are seeing yields slightly higher. You are seeing stocks slightly lower. It could all change. It's a huge week coming up, with the peak being the FOMC meeting and the rate decision on Wednesday. This is Bloomberg.
Go. After hardly a full year of name, image, and likeness deals being a reality, UCLA quarterback Chase Griffin already has more than 20 deals with major brands, venture, and charitable groups, all while balancing graduating undergrad in just 2 years and fighting for playing time on the field.
Chase Griffin out of the gun. We are joined by UCLA quarterback Chase Griffin. Not just UCLA quarterback, but name, image, likeness superstar. I am psyched for this one.
This kid could actually be the president of the United States someday.
When it comes to building generational wealth, it's not about the money that you make in college. I'm very excited that I made the amount of money that I made last year. I am even 10 times more excited that I know how to make that money.
Policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect.
How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is going to be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Down on the session, up big time on a month. I cannot believe tomorrow's November. Live from New York City this morning. Good morning, good morning. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York City, we begin with the big issue.
A step down. Yeah, the step down.
A step down. The prospect of a slower pace of hikes.
Slowing the pace from a 75 basis point hike at this week's meeting to a 50 basis point hike.
75, 50, 50 is very doable.
We are transitioning a new regime.
This rate hike cycle has been extremely aggressive.
It does make sense to start thinking about a slowdown in the pace of hikes.
They're in a tough situation.
You will see a step down.
They can't take rates up at 75 basis points rate indefinitely.
It's really just going to come down to communication in the press conference.
The concern is with the rhetoric that they box themselves into a narrative to save credibility.
Ken Powell will talk about slowing down the pace, but still indicate resolve on fighting inflation.
How do you square that circle? Joining us now is Invesco's Christina Company and Matt Dizok of Bank of America. Christina, first to you. Let's go with this question. How do you signal in December what you're going to do before you even get that CPI data in between this meeting and the next one?
Absolutely, Jonathan. Thanks for having me in. I think for the Fed, it's going to be about communicating that it's a downshift rather than a change in policy from here. And the difference that we're now at restrictive levels of rates, and we obviously know there's a policy lag for these impacts to come through, and we've been moving so quickly, but it's going to be a challenging road for them to navigate because I think the market has continued to push more and more and more from the Fed.
Well, particularly this month, we've just had a massive week of gains, a massive month of gains in the face of this so-called step down, which is driving many of us absolutely nuts, but that's the theme of this week, Matt, so we've got to go with it. Matt Dizok, can you signal a so-called step down without triggering a premature easing of financial conditions?
Yeah, no, that's the problem here, that the Fed has continued to talk about what they're trying to do, but by doing that, they might not actually be able to do it. And so we've heard multiple times from the Fed things they thought they were going to do. They thought inflation was going to be transitory. They thought 75 basis points was off the table. Obviously, neither of those was true. Not 75 was not only not off the table, we've had 4 of them in a row. And so every time they give the market the idea that they're about to pause, there are very good reasons that a pause should be coming soon. We don't dispute that at all. But every time they do that, the market gets ahead of themselves. And even talk of a pause eases financial conditions, gets the market a little bit more excited, gets a little bit ahead of itself. So when they don't know what the future holds, and the future is very uncertain at this point, they should not give forward guidance. They should take a meeting, be data dependent, and let the market sort it out. Because every time they talk about the pause, conditions ease, spreads are tightening, stocks are going back up. They're easing financial conditions just by talking about potentially easing financial conditions, and that's the bind they continue to put themselves in multiple times through the cycle.
Christina, I'll ask a question that I heard from Neil Dutta of Renaissance Macro in the last week as to whether this is just news or noise, because it's implicit in the dot plot, isn't it, that they will have to step down, that they won't be doing 75 basis points forever, and it might well be the December meeting when we get that 50 instead of 75. Is that news?
I think it's about what the market signaled and what do we need to get there. And I think, as you said, it's in the dot plot. It's implied. We know they can't keep at the 75 pace on and on and on. We've gone very quickly. So I think the inflation data can't slow quickly enough to say that this is a change in policy or the end is near, but it can tell us, look, we have enough information that we have to digest it and we can downshift, and let's see what information we get.
I've seen many calls around the Federal Reserve over the next couple of days. We've seen it over the last week. This from Goldman over the weekend, from Jan Hatzius and the team. Goldman saying we're now adding another 25 basis point hike to our own forecast, which now calls for hikes of 75 in November, 50 in December, 25 in February, 25 in March. They now see Fed funds rate peaking at 4.75 to 5%. Evercore have got a tiny little phrase. Take a listen to this. The Fed is gravitating towards the slow stretch and raise approach, slow to 50 in December, but use the new SEP to stretch out hikes with another 25 in March and raise the ex-ante peak rate from 4.5% to 4.75 and the September SEP to 4.75 to 5. Matt, let's talk about the destination and not necessarily the journey. In your view, do you still see any upside risk whatsoever to that terminal rate on the Fed funds?
We do. We absolutely do. And again, we do think that range, sort of 4.75% to 5%, we do think that's the right range. But the future is uncertain, and there is, deviation from that range. It certainly could be to that high side. So slow and stretch, as Evercore put it, or amend and extend, as we put it. Yes, we expect 75 this meeting, probably 50 the next meeting, setting themselves up for another couple of hikes next year to get that 5% level. But again, historically, it has been very difficult to get inflation back to where it started. It doesn't usually happen that quickly. And so again, a 5% rate with inflation 8% is not that unusual. Now again, there are a lot of things in markets, leading economic indicators going negative, money supply growth, M2 actually also going negative, a lot of signs that inflation should drop. But until you see that, you're not sure if it will. And you just cannot model people. You just don't know how people are going to react to inflation. We've seen goods flatten out, right? But how are people going to stop spending? High-income folks still have a lot of disposable income. The labor market is still exceptionally strong. You usually get to 350 to 450,000 unemployment claims a week at the beginning of a recession. We're at 200,000. So there's certainly a case that they have to do more to get the labor market down. They have to go above 5%, which is why, to Christina's point, it was in the dot plot. Let the dot plot speak for itself. Let the data speak for itself. Let the Fed stop talking, do what they need to do. And again, stop signaling the pause, because you use financial conditions and you make the pause paradoxically less likely.
Well, let's talk about the data as well, and we've got to talk about the economy. And you mentioned a few data points. Underneath the surface in GDP, Christina, is pretty clear. Demand is cooling. Underlying demand is cooling. If you'd asked me a number of months ago, for whatever my opinion is worth, I would have thought that by the end of the year, the dual mandate would be in conflict. When you look at the labor market right now, the official data we'll get on Friday, you look at the CPI numbers, as yet, it does not look like that dual mandate is in conflict. Do you expect it to be in conflict, Christina, anytime soon?
We think it does need to, both will come to the forefront. And the interesting thing when we look at this cycle is the cycle has been so compressed. Like coming out of COVID, inflation ramped up so quickly. You've had just such a compressed cycle overall. So we think that the risk that the market's underappreciating is the potential for that compressed cycle on the back end. Is there a potential that inflation comes off quickly? Is there a potential that firms do come back to their traditional behavior and say, look, we need to trim jobs? And I think exactly to your point, the Fed does need to see the unemployment rate go up, and maybe actually negative non-farm payroll prints versus the 350 numbers that we've run at for the last 6 months.
I think we're looking for 190 this Friday.
Yeah.
Still 190K, still in and around 200. Futures right now down 0.5% on the S&P. On the Nasdaq 100, we're down 0.6%. In the bond market, yields a bit higher at the front end, up by 7 basis points, back to about 448. A couple of Fridays ago, 460-ish. So we've backed away since then. On the 10-year, up 3 basis points to just north of 4%. It's not just about the Fed this week. Tons of economic data in between. We've got payrolls on Friday, and we go into the final week of campaigning, going into the midterms next week. Katie Lyons on top of it all. Hey, Katie.
Hey, John. Yeah, a busy week, but really arguably it doesn't start until Wednesday when we get that Fed decision. It's not so much about the actual rate hike this time around. It's likely going to be 75. That is all but a guarantee at this point, the fourth 75 basis point hike in a row. But as you three were just discussing, it's really about the forward view and whether or not the Fed confirms this step down narrative of the idea of only going 50 in December and smaller hikes as well in the beginning of next year. So that press conference from Chairman Powell is going to be absolutely crucial. And as Matt was just talking talking about, this Federal Reserve is going to be following the data. And we do get a lot of data this week. On Thursday, the day after the Fed decision, we will be getting jobless claims. 220,000 is what we're expecting. So roughly in the range of what we've seen for the last several weeks. But that is not a super material softening in this labor market. And of course, that is what the Fed would like to engineer. They want to see demand for labor coming down, which makes Friday's payrolls report crucial. You were right, John. 190,000 on non-farm payrolls is what we're expecting. That is a tick down from December, while unemployment is expected to tick up to 3.6%. And the other figure to watch will be participation. 62.4% is the estimate, and wage growth is expected to come down a bit to 4.7% year on year. And that is not all. This week, we also get a decision from the Bank of England. They too are expected to raise 75 basis points, even though the UK economy likely already is in a recession. And there's more. We still are getting earnings. The season is not yet over. We have about 173 S&P 500 companies reporting over the course of this week. Among the biggest, Pfizer, Qualcomm, ConocoPhillips. So there's a lot of macro to pay attention to, John, and there's some micro as well.
Kelly Lights, thank you. This quote jumped out to me in a Wall Street Journal over the weekend. It came from Rick Reeder of BlackRock. Take a listen to this. I'm more excited going into 2023 than I've been in a really long time. Rick went on to say, because we're going to have so many different opportunities. I'm looking forward to catching up with Rick later this week on Friday. Christina, do you share that view from the fixed income side, that 2023 is lining up to be a year of opportunities? And if you do, where are those opportunities right now?
Yeah, we absolutely do share that view. I think with this potential for the Fed to shift into next year and get closer to the end of the cycle, it opens up a lot of opportunities. In particular, I think the dollar is at a 42-year high in real effective terms. We see that roll over once we have some clarity on the Fed. So we think foreign exchange looks interesting, especially on the emerging market side. I think EM, foreign exchange, sometimes gets a bad rap because it's only looked at first the dollar, but versus a broad basket of DM currencies, it's actually done well, and we continue to like that for next year. And there's a couple other things that strike us. Japan rates are probably an asymmetric to go higher with a potential shift next year for the BOJ. And Brazil assets as a whole on the back of this presidential election, we think there's a lot of opportunity there too.
Matt, do you agree with that sentiment?
Yeah, are you kidding me? Am I excited? I'm popular for the first time in my career, if not my life. This is good. I'm with Rick, man. As a bond nerd, like, we're pretty happy right now. You've got 4% plus. National municipals around 4.25. That's a tax-adjusted yield for a high tax rate person. 4.25. Yield on municipals. Again, you're seeing rates that are not just attractive in the last decade, attractive in the last 20 years. Short corporates, close to 6%. High yield, still not recessionary, but in that mid-9 level. Preferreds, particularly the fixed to float preferreds, the institutional $1,000 par ones, they look relatively attractive here. We feel, in general, a 60-40 portfolio from this point forward is offering some of the best medium to long-term returns that we've seen easily in the last 10 years. So bonds are finally able to do their job again. They can diversify now in two ways. They can give you additional income. So again, if you build that portfolio of 5 to 6% yields, you can get an additional 5 to 6% additional return to your portfolio over time. You haven't seen that in many, many years. Secondly, though, now that rates are a lot higher, they can actually move down in yield and up in price if we get a significant economic recession. When rates are 50 basis points or basis point, and the Fed caps itself, or floors itself at 0, won't go below that, you don't get a lot of diversification in terms of that price benefit. Higher rates are giving you that double bang for your buck now. The higher yield, diversification, and portfolio returns, and the ability to drop significant yield potentially if the economy suffers. So, yeah, I'm feeling pretty good for 2023.
Fixed income kids are the popular guys at school all of a sudden. Christina, final question. You get the final word. Do you think this is the new normal or just a moment in time? Is this the new normal or a moment in time?
I think it's the new normal. I think we're in for a world with more volatility and more potential for different asset classes to look interesting. I think we've walked away from this world of zero at the zero lower bound, and we're in for exciting markets from here.
Keep hearing this again and again. Christina, thank you. Christina Campmany alongside Matt Diesel. Futures right now down about 0.5%. Let's get you some movers going into the open. Here's Abby.
Hey, John. Well, after two big up weeks, we are taking a pause here for U.S. stocks, at least ahead of the open, and one One sector that's under pressure, energy, with oil down more than 1%. We're seeing tremendous underperformance, though, from Brazilian assets. This, of course, on Lula's presidential win. Assets are down overall. One index just opening down more than 6%. Petrobras really underperforming, down 6.5%. Investors waiting for direction, especially around Lula's cabinet. As for other laggards on the day, Apple is a big drag, down more than 1% after its best day last Friday since July of 2020, on basically being the best house on a bad block among other tech stocks. We also have Alibaba down 1.1%, some weak factory and manufacturing data out of China. On the other hand, Wynn Resorts up 5.5%, more than 40% of their revenue comes from Macau, and Beijing says mainland residents can apply for electronic travel permits starting tomorrow. Some thought that will help. And then, John, finally, I hate to say it, this is really the ultimate sign of the bear market rally. The meme stocks are back. GameStop and AMC higher. GameStop up right now for 11.7%. For what reason? Who knows?
Abby, thank you. Abigail Doolittle on some of the names going into the opening bout to look at. Futures right now down about 0.5% on the S&P. Over to the bond market with yields higher, particularly at the front end, up by 7 basis points to just short of 450. In the FX market, bit of dollar strength off the back of some of that euro weakness. Euro dollar just about holding on to a 99 handle on euro dollar. CPI earlier this morning, dreadful for the ECB, 10.7%. We were looking for 10.3, and in the oil market, crude is down by a little more than 1%, 86 on WTI on Brent, just short of 95. Coming up, President Biden with a message for big oil.
The last quarter, companies made $70 billion in profit. And I'm going to keep harping on it. They talk about me picking on them. They ain't seen nothing yet.
That conversation up next.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
I think to be successful in a role like this, it is not only technical knowledge. It is about passion.
They have to love Oreos, right?
They do.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
Part of what I love about business is you get to build things from nothing.
I don't have any investors. All this is all money in. This is me just building it, building it, building it.
Shell made $9.5 billion, Exxon $18.7 billion in 90 days. Those excess profits are going back to their shareholders and their executives instead of going to lower prices at the pump and give relief to the American people who deserve it and need it. And I'm going to keep harping on it. They talk about me picking on them. They ain't seen nothing yet. I mean it. It outrages me
The White House taking aim at big oil's record profits. Exxon CEO speaking on its earnings call saying the following: there has been discussion in the US about our industry, returning some of our profits directly to the American people. That's exactly what we're doing in the form of our quarterly dividend. The president firing back in a tweet: can't believe I have to say this, but giving profits to shareholders is not the same as bringing prices down for American families. Team coverage starts right now with AMH down in DC alongside Will Kennedy over in London. AMH, walk me through the latest comments from the president.
Well, the president once again lambasting the oil industry, Jonathan. It's pretty easy for him to do when you think of the size and scope of some of these profits. Exxon alone, if you break it down hourly, they made $7 million an hour. And at the same time, the president over the summer has really struggled with his poll numbers, which reflected higher gasoline prices, which is why you see the White House and the chief of staff, Ron Klain, continuously reminding the American people that over the course of the last 14 days or so, we have ticked up the last 2 days, but gasoline prices have come down. One thing we should know, and I know Will Kennedy's over in Europe, which is why I want to bring up this point, a lot of rhetoric from this administration about the oil industry and from Democrats in general. We had Senator Murphy saying if Republicans get in power, these guys, meaning the oil companies, these Republicans are going to do their bidding. But even though the Democrats hold both chambers and have both powers, we have not seen windfall taxes like we've seen in Europe on some of these oil companies.
Will, what's the response from big oil?
Well, I think the big twofold. I think you've got the Woods position, which is, you know, it's our duty to return it back to shareholders, and many shareholders are ordinary Americans. I mean, that does rather ignore the fact that I think about 90% of shares are held by the richest 10% of Americans. But his point is that, you know, they are doing what their fiduciary duty is, which is to take profits and redistribute them. I think, and be very against the windfall tax. I think in Europe, the things are a bit different. Obviously, in the UK, for example, and in EU, we've had some windfall taxes already. I think there's more of an acceptance that the political weather is changing, and they need to, you know, roll with that background. So we had Ben van Beurden, the outgoing chairman of Shell, CEO of Shell rather, saying last week that he understands that higher taxes are coming for the industry given the cost of living crisis and given the exceptional profits that they're making. So I think, as so often with big oil, you've got slightly different situations on either side of the Atlantic.
MH, as is also very often, good politics is not the same as good policy. When I hear this, I often ask myself the question, AMH, Anne-Marie, if they're unhappy with these margins, with these capital returns, do they come out and tell you specifically what kind of margins, what kind of capital returns they are satisfied with? Is there a percentage, a number, or is this just rhetoric?
This is just rhetoric. But one thing I can say that I know in terms of speaking to officials when it comes to the price of gasoline, which is why they go after the oil companies, of course, and they want to see a lower gasoline price, they say that the margin the refiners are making are way too big. And right now, when you see gasoline hovering around $3.70, officials think that actually looking at the data, it should be closer to $3.20. What they really want to see from all of these companies in the energy industry is to, at this moment, as they are dealing with a 40-year high inflation, gasoline prices, prices of food, gasoline, of course, and all commodities stem into higher inflation of food costs as well, because we are a farm-to-truck nation. They want to see these prices come lower. So it's rhetoric right now, but they haven't given exact margins, et cetera, and how they think these oil companies should go forth on that path, Jonathan.
I don't think we're going to get them anytime soon. Will, I wanted to fit this in. This is serious stuff. The Black Sea grain deal looks like it's breaking down. The Russian ambassador to Turkey and the UN, a key feature in putting this together earlier this summer, saying that we don't see the promises made to us on the easing of our exports were kept. Russia can no longer guarantee the safety of civilian dry cargo ships in the Black Sea initiative. Will, can you walk us through how potentially serious and severe this could be for certain countries depending on those exports?
It could be very severe, and you've seen some reaction this morning, as you're showing on your screen there, with wheat futures up as much as 5%, now up about 4% this morning, showing that the market takes this very seriously. It's a fluid situation. We don't know exactly how it's going to work out. John, on the one hand, Russia has backed out of this deal, says it's suspending its cooperation. On the other, the Turks, the UN, the Ukrainians say that the ships are going to keep leaving Ukraine, and some ships have already left this morning, we understand, carrying cargo. So the ball is very much in the Russians' court. Now, Russia faces a very difficult decision here. On the one hand, if it lets the grain keep on flowing, then it will look like a toothless tiger. But on the other, is it really going to disrupt the flow of food out of Ukraine? I know they've done a lot of things that have heaped opprobrium on them over the last year, but actually intervening to stop shipping of grain to developing nations would be a very difficult thing to do. So we'll just have to keep watching.
Well, I know this is a massive story for you and the team in London, and we'll keep on top of it with you through the week. Will Kennedy, AMH, down in DC and in London too. From New York, your morning calls. Up next.
Some years ago, this little town became famous for having 5 centenarians and made it to the cover of National Geographic, having 5 centenarians out of a couple of thousand people.
Io 102 anni. Qual è il segreto? Non lo so. Io mangio sempre semplice.
Fasting is such an interesting part of the longevity conversation. And ask the question of, well, why are these people living so long?
Fasting has been done for thousands of years, of course, but we now have to move away again from these ideas of eating or fasting. They both mean very little. I've seen 110 healthy, but it's not going to be doable for the entire world population. It's going to be doable, I think, for the people that listen and follow all the right moves.
In London, in Sydney, in San Francisco,
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story. How are you thinking about those dynamics?
Equities down. Let's get you some morning calls. First up, UBS downgrading Caterpillar to neutral, seeing little remaining upside. Truist downgrading Keurig Dr. Pepper to sell, expecting higher inflation to weigh on sales growth. And finally, Wells Fargo downgrading Paramount to underweight, noting rich valuation and worsening trends in media. Up next, your opening bell.
Thing in life I've often said is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy in 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like. But the more you could be you, the happier you will be.
Power, policy, politics. From the White House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect.
How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg. Innovation, money, and power collide in Silicon Valley and beyond. Bloomberg Technology with Emily Chang. Weekdays at 5 p.m. in New York and 2 p.m. in San Francisco.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
23 seconds away from the open and bow this morning. Good morning. Last week, big week of gains, even with some severe damage done to some big tech names. Futures right now down about 6 or 7/10% on the session. On the month, we're up close to 9% on the S&P. That's S&P 500 futures, NASDAQ futures down about 0.9% going into the open and bow. There is your open and bow. Switch at the board and get to the bond market. Yields up on a 2-year. And that is pushing yields higher across the curve, up 3 basis points on a 10-year to 4.0457. Call it 4.05% on a 10-year, up by 3 basis points. With yields higher, dollar stronger, euro-dollar holding on to 99. Euro-dollar 0.9905 with negative 0.6%. Some euro weakness in the mix off the back of Eurozone CPI coming in very, very close to 11% at 10.7. Our survey said 10.3. The previous number, 10.0. In the commodity market, down 2% on crude, $86 and around about 20 cents. PMIs out of China overnight and over the weekend, not great at all. We got PMIs in the 40s in China, PMIs in Europe in the 40s also. Get the ISM in America coming up tomorrow. So about 50 seconds into this, your market action, your price action looks a little something like this on the S&P 500. Equities are down by 0.6% on the NASDAQ. We're down about 6 or 7/10%. Brutal week for the FANG stocks last week, with the exception of Apple. It was everything across the board. It was Alphabet, it was Microsoft, it was Meta, it was Amazon. Ed Ludlow, busy week for you, sir. That was brutal.
Yeah, it was busy, and to quantify how brutal, $370 billion of market cap lost with everyone, with the exception of Apple, right? And what's so interesting is how you slice and dice it. You're coming off the first 2-week gain on the NASDAQ 100 since mid-August, and October has been relatively positive. Best month for the NASDAQ 100 since, I believe, July. But when you stack technology side by side with the broader market, the NASDAQ 100 relative to the S&P 500, this was the second worst monthly performance for the NASDAQ 100 relative to the S&P 500 since 2008. Really, this tech sector is becoming a laggard, a rare laggard around earnings season. Those 3 or 4 names, when you strip out Apple, are also having a pretty terrible month if you try and quantify it in terms of market cap loss. You look at Amazon down 100 billion, Meta down 101 billion, Tesla down $110 billion worth of market cap. Then there's actually the performance of earnings. I think we're around 50% through the way of this earnings season on the S&P 500, and things looking pretty positive. I think of the 5 out of 11 sectors, tech that are underperforming, tech is actually doing pretty poorly, John, in the scheme of things. Overall EPS up around 2% year on year for the S&P 500. You can see there on your screen that tech, from an EPS perspective, is down almost 6% year on year. So this is a rare situation we find ourselves in. I would say, John, like you and I, the market probably has its eye firmly on the next Fed meeting this week.
Oh, without a doubt, and the one after that, and then into 2023. And it was the breadth of the story last week that you and I discussed. It was ad spend at the likes of Alphabet. It was the e-commerce story at Amazon for the holiday period still to come. It was IT budgets elsewhere at Microsoft. It was the breadth of it, Ed, that really got my attention. What got yours?
Yeah, I think if you take Amazon as the example, we kind of knew that companies that gave weak current period or year-end forecasts would get punished. But actually, if you look deep into the commentary, they were hit by higher energy prices. They gave some granularity around inflation hitting the consumer. The ad business didn't come in to save the day, of course, it was weak. AWS showed evidence that corporate spending wasn't good. I think about Microsoft as well, that talked about some corporates putting off bigger cloud projects and doing shorter-term, smaller contracts. There's nervousness out there, and it is broad. It's not just the consumer-facing business, but there's some evidence that the corporate story is unraveling a bit too.
Ed, thank you. Ed Ludlow on the West Coast. We'll catch up with you a little bit later to talk about Twitter, of course. Last week's rally, we give some of that back this morning. The S&P 500 down 0.75%. Story of the session, really the story of the year. Underperformance on information technology, relative outperformance on energy. Energy up by about 0.2%. That's where your outperformance is. There in utilities, for that matter. Elsewhere, information technology, communication services down about 1%. IT on the S&P down by about 1.3%. On leadership, Clear Harbors, Aaron Kennan has this to say: the recent outperformance of value stocks give us some pause. Growth stocks have been battered as of late and now stand nearly 26% below last fall's levels. Looking into 23 and beyond, growth stocks may well hold the greater promise. Aaron, I'm pleased to say, joins us right now. Aaron, it's been too long. Let's get straight to it. Why do they hold the greater promise for you?
Well, I think if you look beneath the mega cap headline story of last week, Jonathan, and you look at sort of the equal weight, the battering has been even worse. From peak to trough, it's, the average NASDAQ stock was off more than 50%. And so there are some, diamonds in the rough there. And we even saw that last week where you had, companies like ServiceNow and Qualtrics that are really focused on consumer content, on employer satisfaction, really, rallying. And these stocks have been battered on a year-to-date basis, but perhaps they're finding a bit of a bottom here. But I think at the end of the day, this is still a story about where does the neutral rate end up residing? Is it at 4.5 or 5 or perhaps higher? Because at the end of the day, we know that the risk-free rate of return is the treasury market, and discounted cash flow analysis would suggest that multiples will come down if rates continue to go up, as we need a higher discount rate. So, lots of risks out there to the growth story for sure.
You mentioned the damage. Microsoft year to date down 30%. Alphabet before today down 33%. Amazon down close to 40%. Meta down 70%. Ed Ludlow and I were just talking about the breadth of the weakness that we've seen. It's cloud, it's e-commerce, it's ad spend. If you think about where the durable profit machine is, Aaron, can you give me an idea of what the business model is that actually you want to really strap into for the next couple of years?
Well, it's not just in growth, for sure. I mean, last week, the story was really an interestingly glass half full story for industrials. Look at Caterpillar. Look at Honeywell, Jonathan. You can see them able to finally push through pricing to the end demand, to the end customer. That's quite a positive story. That was the story for last week. Certainly, we're going to continue to see pressure, I think, in these mega cap companies, particularly on the advertisement front, as we start to see the consumer under further pressure, as those bank accounts, as those money market accounts dwindle after a significant amount of fiscal stimulus that placed money into individual and family bank accounts from 2020 and 21 with COVID. That's starting to falter, along with the money supply trends. And so, certainly some pressure for the consumer as we go into 2023. Even on the retail sales front, you saw Japan last night report very strong retail sales. But why is that? It's because the product price has actually gone up. The units purchased has not. And so I think that's a story that we're going to start to see play out here in the U.S., putting pressure on consumers.
You mentioned Caterpillar, up 15% last week. That's the best week since 2009. UBS downgraded the stock this morning to neutral, said there was little remaining upside. I won't speak for UBS, Aaron, but I'll speak for other people that come on this program who just don't believe in this new normal in the equity market. They think we just go back to the pre-pandemic trends, where you have a backdrop of low growth, low inflation, and low rates supporting growth equities in a market cap weighted S&P 500. Aaron, is there any question as to whether we go back to that or not?
Well, we don't know is the short answer, but certainly we've seen a rotation in leadership. You look at the energy complex up well over 50% year to date on average across the board. They're 5% of the S&P, but 10% of earnings. I think there's been a sort of a whole rethink on the value of energy, both from policymakers and investors. And if you look at multiples within the industrial sector, sure, they're down quite a bit, and multiples are down significantly on the growth side. So there's certainly a greater margin of safety here on a go-forward basis, for sure. But there's also this risk out there that inflation remains pronounced into 2023. And if employment starts cracking, and we'll receive some signs on the JOLTS data midweek and jobs data later this week, and the aggregate demand curve really starts faltering as the Fed hopes, and inflation doesn't come off, I think that's a growing tail risk for the Fed. It's in some sense what we've been seeing in the UK, where they lost control of their interest rate structure. So we're sort of mindful of all these sort of widening tail risks too in the market.
And just a final question from me on lost decades. It's something I've gone back to a few times over the last few months. They're not unheard of. When you get big busts like the one we've seen over the last 12 months, think about the banks post-financial crisis, particularly the banks over in Europe. You can think about tech post-2000. You can think about what happened with Japan several decades ago. I mean, take your pick. Lost decades can happen. Do you think that is what is about to happen in certain pockets of this market? And if so, where?
Well, sure. I mean, we have segments of the market that will probably experience multiple years of pressure. I think, depending on the directionality of inflation and interest rates, will we continue to see pressure on multiples within the tech sector, even if tech continues to grow? It's a rather important question. I also think, not all is lost. If we still see interest rates in this sort of positive regime, which we haven't seen since the Great Recession for years. Real interest rates are positive, nominal rates are positive. We're going to have policymakers sort of rethinking how they talk about deficit growth and deficit spending. We're going to have corporations thinking about their balance sheets, and we're going to have consumers that no longer can receive a 3.5% mortgage, but a 7.5% mortgage and a zero interest rate car loan, reconsidering their spending patterns. And this may end up being a healthy setup for the long term, but we're not there yet. I think when we get there, multiples will probably still be lower. Remember, markets tend not to bottom in bear markets until the Fed has stopped raising rates. And we're getting signals that the Fed has not stopped raising rates yet. So there's a lot to ponder here. Maybe the Gramm-Rubin Balanced Budget Act will come into conversation, and we'll stop talking about modern monetary theory, and that'll be a welcome trend too.
I thought we'd stop talking about that already, given the developments of the last 12 months. The equity market down, Aaron, at the moment by about 0.8 on the S&P. We're down 0.5% on the Nasdaq. We're down 0.8%. What are the final word from you on the note we got from Mike Wilson over at Morgan Stanley over the weekend, overnight into this morning? He said weak 3Q earnings hammered some of the biggest tech darlings, yet the S&P 500 and even the Nasdaq 100 ended the week up. You and I have been talking about that. Their call is for this rally to reach maybe 4,000 to 4,150. They're leaning towards the upper bound of that range. That's a near-term call. Aaron, do you want to keep riding that wave as well?
Well, it's interesting. We've had such significant depression in consumer investment sentiment, both on the institutional side as well as the retail side. We've seen high cash balances at mutual funds, high cash balances at long-only asset managers and even hedge funds. And we've seen high, levels of short interest. So any sign that maybe the future is not as bad as the analysts expect has prompted a sense that maybe markets can rally from here. And I think that's what Mike Wilson and others, including myself, how they feel as we sort of approach or wade through the fall period. I think this could maybe be a false dawn, but certainly there's a basis right now for this rally to continue on the margin.
Until we see the earnings damage potentially in this quarter that shows up in January. Aaron, fantastic to get your thoughts, as always. Aaron Cannon there of Clear Harbor on the latest. The S&P down 0.5%, the Nasdaq down 0.8%. Coming up, Twitter entering a new chapter with Elon Musk taking the helm.
Elon's one of the most creative entrepreneurs we've seen in this era, so don't want to bet against him. I think he does have some challenges, a little bit like the dog that caught the car, and it's a little bit now what?
That conversation up next.
did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is going to be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Apple's delaying its next major iPad software update, iPadOS 16, by about a month from September to October. Apple made the decision for a number of reasons, including a still buggy Stage Manager multitasking interface and in order to link the launch closer to the more similar macOS Ventura. Still, it's an unusual move. Since shifting the launches to the fall in 2011, Apple has released its new iPhone and iPad software updates simultaneously each year around September. By staggering the releases, users may find some issues around compatibility with cross-device features like retracting and editing messages in iMessage, the new shared iCloud photo library, and the new feature for transferring FaceTime calls between iPhones and iPads. It will also make it a bit harder for developers to launch apps that run on both the iPad and iPhone that require new APIs and features found across iPadOS 16 and iOS 16. Regardless, it was still, of course, the right move. Stage Manager on iPadOS 16 is still quite buggy. I don't find it particularly intuitive, and it's not compatible with most iPads and many third-party apps on the App Store. The feature clearly needs some more polish. And complaints from consumers about Stage Manager will now no longer probably overshadow the earlier launch of the iPhone 14.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles to become chief future officers. Duke Energy has an ambitious plan to transition to clean energy, and new CFO Brian Savoy is ready to lead the charge.
We're going to invest $145 billion over a decade. There's a lot going on, but I wouldn't have it any other way.
Watch Chief Future Officer Wednesday on Bloomberg.
Elon's one of the most creative entrepreneurs we've seen in this era, so don't want to bet against him. I think he does have some challenges, a little bit like the dog that caught the car, and it's a little bit now what. And I know he wants to make some moves around making it more of a town square, but I think he'll need to be careful in terms of making sure he doesn't lose users, doesn't lose advertisers, doesn't trigger more regulations.
The Twitter drama showing no signs of letting up now that Elon Musk is in charge. Bloomberg reporting that he's preparing for a round of job cuts, while Musk denies he holds the role of CEO, tweeting the following: "My title is Chief Twit right now. It's right there in the bio. No idea who the CEO is." Ed Ludlow back with us for more. Ed, walk us through where we are in this one.
Yeah, well, good morning, Jonathan. I mean, headlines crossing the Bloomberg terminal for what it's worth that the two parties in the deal, Musk and Twitter, have asked the court to dismiss lawsuits on either side now that the deal is officially closed. I think the other PSA is that Twitter offering to buy all of their outstanding bonds, right? That's the 3.875% senior note due 2027, the 5% senior note due 2030, and the offer price is 101% of the principal plus any accrued or unpaid interest. So that's kind of your PSA. You're right, we reported over the weekend that within Twitter, senior managers have been asked to draw up lists of those that they feel could be cut. And I guess, you know, the conversation's quickly turning to what the company looks like in the future. In many senses, Musk is looking to the past. We've had disclosures on Twitter that David Sachs, who Elon Musk knows from his days at PayPal, Jason Calacanis, who is a well-known investor and a friend of Elon Musk's, and also Sriram Krishnan, who's currently a general partner at Andreessen Horowitz, are all inside what is being billed the war room to kind of work out what this platform looks like going forward. It's all about, I guess, a plan to grow the user base that's never really breached 250 million, despite plans that have been in place for a decade to kind of get Twitter to 1 billion users as a base. What will they do to do that? We don't really know. There's been a lot of reporting and tweeting from those in this war room about about the idea of charging for blue check verification. Jason Calacanis, for example, tweeted out a poll asking how much would you be willing to pay to have a blue check mark verification. I think the overwhelming majority of respondents said that they would not be willing to pay anything, but that's where we're going. I think we're just waiting for some concrete confirmation of layoffs, any size or scope on that, and which teams are impacted.
And sit tight, because I want to get to Kaylee on a story about advertising, and I think this could become a bigger issue in the weeks to come. This was from GM going into the weekend, temporarily suspending their advertising on the platform. They said this: "We're engaging with Twitter to understand the direction of the platform under their new ownership. As is normal course of business with a significant change in a media platform, we have temporarily paused our paid advertising." Kaylee, your thoughts on this one as it broke on Friday?
It's an interesting one. GM essentially saying we're just going to sit back for a bit and see how things evolve, that they're still going to engage with customers on the platform. They're just not going to spend money advertising there. And there is a bit of a competition question because GM is an automaker and Tesla and Elon Musk. There is a bit of a dual force here where automakers may have to consider that this man not only controls the social media company they are advertising on, but also a competitor as they push into the EV space. So that is a consideration not just for GM, but Ford as well, which has said via a spokesperson it is not currently advertising on Twitter. And of course, these two companies are important because they spend a lot of money on ads. Last year, GM spent about $2.7 billion on advertising. Ford spent about $2 billion. You have the likes of Stellantis around that figure as well. So Twitter could potentially be missing out on some big dollar figures here without these guys. And if it wants to make money, it really needs ads to do that. That is what Twitter's revenue model to this point is based on. And Elon Musk claimed to investors that he wants to triple that revenue within 6 years. That's going to be tough when the trend already was working against him. We actually saw a drop-off, negative revenue growth earlier for Twitter this year. And that probably helps explain why last week he tweeted out a letter to advertisers saying in part he wanted to, quote, fundamentally mean Twitter aspire to be the most respected advertising platform in the world. We can see if he will indeed be able to turn into it, John, because Elon Musk has tended to be quite a polarizing figure, and there's a lot of question marks about what exactly he's trying to accomplish here.
Kelly, thank you. Ed, final word on this one. GM says it's a normal course of business, new owner of a new platform. What's your response to it?
I don't think it's the normal course of business, really, is it? I mean, Kaylee touched on the point that this is a company that has close ties to Tesla. As I've reported, there are Tesla engineers inside Twitter's HQ right now assessing the code, assessing and basically vetting Twitter's software staff. So, you know, it's an interesting one. One quick point on the CEO title, John. Remember last year, Musk said that as Tesla, CEO was a made-up title and that actually he was Techno King. If you go to Tesla's IR website, it clearly lists Musk as CEO and gives all of the other titles that he officially holds. It does not list on Tesla's IR site Chief Twit.
Ed Ludlow, I'm almost bursting out laughing sitting here. Ed, thank you, as always, buddy. Good to see you. 21 minutes into the session, we're down by 0.9% on the S&P. On the Nasdaq, we're down by 1.2%. Bit of economic data out moments ago, and I can tell you, it wasn't great. With it, here's Abby.
It was not great at all, John. And of course, you're talking about that Chicago PMI coming in at 45.2 for the month of October, down from this survey. The survey was expecting 47, and down from September also 45.7. So you were talking about how China and the Eurozone have PMIs in the 40s. Well, Chicago is too, and that's manufacturing, publishing, transportation. It's going to be interesting, of course, to see that ISM number tomorrow, which is expected right at 50. 50, as you know, the divider between contraction and expansion. Chicago right now in contraction. Let's see whether or not the ISM can stay on the positive side of things. Taking a look at sectors, now you can make the case that that Chicago PMI is bad news, so that should be good news because it would, in theory, maybe mean that rates would go down. That's not the case. We're looking at a bearish day. Stocks down overall about 0.9%. Most sectors lower, led by tech and consumer discretionary. You also have real estate and utilities down because yields are higher. Those rich dividend stocks, they are down. The one sector that's higher, not surprisingly, energy. It's up 0.8%. Actually, I should say it is a little bit surprising, only from the standpoint that oil is down. But the reason I'm saying it's not surprising, this is the best sector on the month. In fact, energy this month up 25%. Its best month going all the way back to November of 2020. We can also see that capital goods are higher in the month. You were just talking about Caterpillar having its best.
on the S&P. On the Nasdaq, down by 1.2%. Yields up at the front end, very close to 450 on a 2-year, up by 8 basis points. Yields higher, stocks down, dollar stronger, euro dollar just a break of 99, 98.95 right now on euro dollar. That currency pair negative 0.7%. Big week ahead. Up next, your trading diary.
Incredibly difficult for all types of companies to find employees lately. Many people with disabilities who aren't working could be working if only given a job. About 20% of people with disabilities are employed.
Right now, we're in an environment where there is a war on talent out in the marketplace. Every employer out there is struggling to find people to come into their shops and to find good, hard-working, dedicated employees. We have found through this program and other ones like it that we have within the organization that these individuals are looking for meaningful employment.
People with disabilities want to be able to live, work, and recreate in the community the same as everybody else.
Many of us identify ourselves right away by our job title. That's an important part of our image of ourselves. So that's true for all of us, whether or not you have a disability.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
It's a pretty negative start to Fed decision week. Equities down 0.8% on the S&P, and the Nasdaq negative 1.4%. That's the price action. Here's the trading diary. Manufacturing PMIs and ISM numbers coming up on Tuesday, followed by weaker central bank decisions, with the RBA up first, the Fed and Chairman Powell's news conference on Wednesday. Then the Bank of England decides. Plus, we get US jobless claims on Thursday. And finally, closing out the week with the main event, it's Payrolls Friday. Coming up very shortly. What a week we've got lined up for you. From New York City, equities down by 0.9 on the S&P. Thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
Thinking big from the beginning. I mean, the reason that I was interested in doing this in the first place was a much bigger challenge than making a comfortable shoe or doing something in the fashion industry as a narrow opportunity. We thought that there was a big leadership opportunity. We looked around at an industry where there was 20 billion pairs of sneakers made every single year, and it was 100% made from plastic and the hides from cows, and it was terrible for the environment. And we thought that we could offer something to consumers that was differentiated in the way it feels, more comfortable, higher performance, and do that because we use sustainable materials. And in doing so, we could take a really interesting leadership opportunity and grab that and use that to tell a totally different story and compete on a totally different vector than what the rest of the industry were doing.
You will put a woman on Mars. You will bring forth global cooling. You will be the first chief crypto officer. Because when you subscribe to Bloomberg, you won't just get news. You'll get insight into limitless possibilities, knowledge, and inspiration to feed your ambition. So before you invent, pioneer, disrupt, before you change the world, Bloomberg.
Pepsi's Number Fever campaign in the Philippines has probably gone down in history as one of the biggest marketing disasters in history, mainly because of a human error that led Pepsi to print more winning caps than they planned. The resulting chaos caused riots, civil unrest, and even deaths. Reporting this story took over a year, and it resulted in me flying to Manila in the Philippines to meet unlucky winners and to find out exactly what happened back then in the 1990s. My name is Jeff Maish. I'm a journalist based in Los Angeles. I wrote the story for Bloomberg Business Week about Pepsi's Number Fever campaign. The Philippines is a really interesting country. It's made up of thousands of islands, and it's also a country that's very heavily influenced by America. American culture is everywhere you look in the Philippines. They're obsessed with Frank Sinatra music, for example. They love all things America, and that extends to their love for soft drinks, Pepsi Cola, Coca-Cola. In the 1990s, it was everywhere. Is now not. Number became number over these caps. There were signs that there were going to be problems with Number Fever very early. Pepsi had rolled out the competition in Chile, and a garbled fax had caused some kind of problem with the winning number. They'd announced the wrong one in Chile, causing riots. There were signs that there could be big problems ahead if they didn't keep their eye on the ball. So in 1992, Pepsi decided to extend the campaign in the Philippines, and they announced that the competition would go on for a few more weeks. One night, on the television news, they announced the latest winning number, 349. The problem was, 349 had already been allocated as a non-winning number in earlier campaigns. So there were literally hundreds of thousands of bottle caps with 349 just floating around the Philippines. Hundreds of thousands of people all across the Philippines, thousands of islands, were finding winning bottle caps. 349, 349. Some people had 10 lucky 349 bottle caps. People were dancing in the street, celebrating. They thought their problems were over. They were millionaires. It's still not certain exactly how many winners there were of lucky 349 bottle caps, but we know that Pepsi printed over 600,000 of them. Pepsi realized very early that there was a problem. Hundreds of people started arriving at their bottling plants with their lucky bottle caps. They realized something was seriously wrong. Pepsi tried to solve the problem by offering a small token donation to anyone that brought a lucky bottle cap to their bottling plant. But it wasn't enough. People didn't want just a handful of pesos. People wanted their million-peso prize. Within a year, violent protests and riots outside Pepsi factories would leave dozens injured and 5 people dead. At one Pepsi factory in the Philippines, a grenade was thrown through the window. It killed 3 Pepsi employees. Anacita Rosario was a school teacher living near Manila in the Philippines. She was one of the tragic victims of this whole thing. She was walking to a nearby store to buy some rice one day when a Molotov cocktail was thrown at a Pepsi truck in a violent protest. It bounced under the truck and exploded. It killed her and an innocent bystander who was just a child and injured many others. When I was in the Philippines, I tracked down Anacita's daughter, Cindy, and her husband, Raul. It was clear to me that they were still very upset by the whole thing. You know, a family had been ripped apart by this competition. And Raul told me that he'd never remarried. He'd told me that he'd gone to meet Pepsi executives after his wife was killed. And he was angry. He said to them, you know, this wouldn't have happened if it wasn't for you, if it wasn't for Number Fever. The biggest revelation from my reporting was rumors that Pepsi was somehow involved in bombing their own trucks. I found a newspaper report with a headline that said, "Pepsi goons bomb their own trucks." And when I visited the MBI, the police department in the Philippines, they presented me with documents and interviews with people who claimed that Pepsi had paid them to cause riots and to cause trouble outside their plants in order to destabilize the situation and to frame the owners of the coalitions that were fighting them, to try and curry favor. I just thought that was so shocking. And of course, Pepsi denied it, but how bizarre that a company would be accused of bombing their own trucks. The contest had sparked so much anger in the Philippines because it landed at just this really weird time in the Philippines' history. It was during a crazy election that was racked with allegations of fraud. The Philippines was in a kind of love-hate relationship with America. They loved, obviously, the American aid and finances that was pouring into the country, but at the same time, they yearned for independence. They wanted to be their own country. Vicente Del Fierro was a local preacher living in Manila, and he hated the Number Fever campaign. Del Fierro thought Pepsi's Number Fever campaign was just one of the many ways that America was asserting its dominance over a third world country. He hated seeing his fellow countrymen get ripped off, in his eyes, by this huge multinational American company. He wanted justice. Del Fierro rounded up over 800 winners of 349 bottle caps, and he got them all together to sue Pepsi for over $400 million to be divided between those holders of lucky bottle caps. Del Fierro took money from some of the people who could afford it. They paid him 500 pesos to help with legal fees, but for people who couldn't afford the money, he would just represent them pro bono.
The alliance is to build up pressure on Pepsi. And so you see people marching in the streets. So we have mounted our own campaign, even in the U.S.
He flew to America and he hired 2 consumer lawyers here in America to take on Pepsi. He had a meeting at Pepsi's headquarters to try and resolve the problem, but he said he wanted to take it all the way to the highest courts in America. When those cases were heard in America, those courts decided that this was a problem that should be heard in the Philippines, not in America. Back in the Philippines, Del Fierro continued his case in the Filipino courts. At one stage, there were arrest warrants handed out for 9 Pepsi-Cola executives, which he saw as a big victory. We don't know if those arrest warrants were ever upheld, but it made newspaper headlines across the country. Pepsi did not take kindly to Del Fierro's campaign. They tried everything to shut him down. They sued him for libel.
My father had to attend 3 times a month for a branch 145 and another hearing for the branch 113A, also 3 times a month. Also, there was a time my father was hospital due to heart failure. Still, he had to attend the 2 branch hearing. Otherwise, for not attending, the judge will issue warrant of arrest to my father. My father passed away January 13, 2010. After staying for almost 1 year in the hospital, he died of complication due to heart failure. After the death of my father, I was inspired to do the website. PepsiCo will be remembered for what they did to the consumer in the Philippines and to my father.
When I reached out to Pepsi for comment for this story, they claimed that they didn't have access to anyone who was working at Pepsi that was around in those days. They also said that during COVID-19, they didn't have access to their documents about this, but you know, they were very careful to say that they were sorry for everything that happened, and we do know that Pepsi did try everything to try and make this right. The Pepsi number fever disaster cost the company millions. We know that they paid up to $10 million in those goodwill payments, but the financial effect could be much greater. After the disaster, we know that Pepsi sales dipped. They were overtaken by Coca-Cola again. Pepsi's number fever disaster changed the legacy of that soft drink in the Philippines forever. Some people of a certain age won't touch it. For many people, Pepsi is a taboo word. A lot of the people that I spoke to were still quite traumatized by their experience, by that experience of winning $1 million pesos, losing it, and then returning to their normal life in poverty in Manila.
When the news of the bombing came out, it was a massive story in Germany.
We are following some breaking news coming to us out of Dortmund in Germany.
It was covered by all the media outlets.
3 roadside explosions triggered at the same time last night as the coach left its hotel in the south of Dortmund.
Public figures commented on it.
We should not let them affect our life, whoever it was.
The media echo went far beyond Dortmund.
I think it was front page news in every single big paper around Europe. Everyone thought of like a terrorist attack, and people were scared that throughout the city in Dortmund there was more attacks to be happening.
Unbeknownst to investigators, just after the bomb went off and the players of the team were shell-shocked, the person who had masterminded the attack was actually sitting in the hotel eating steak and sweet potatoes. My name is Thomas Rogers. I'm the journalist who wrote the article, The Get-Rich-Quick Scheme That Nearly Killed a German Soccer Team. Dortmund is a mid-sized city in the western part of Germany in a state called North Rhine-Westphalia. And it's a former industrial city that's kind of fallen on hard times in the last few decades. It was severely bombed in the war. So the center of the city is quite stark. Some of the few high points include its soccer team.
My name is Ike Henning. I'm a reporter with Bloomberg News, and I'm a great fan of Borussia Dortmund. Dortmund fans are super loyal. On all match days, the entire city is in black and yellow. It's like a religion.
I think more than most German cities, soccer does play a very large role in the identity of Dortmund. In October of 2000, the BVB became the first team in the Bundesliga to run up very dramatically. With such high prices, they thought that by going public, they would be able to compete better with big teams like Munich.
Unfortunately, many expensive players, high wages, and the club almost went in 2005.
Players, it has, but mostly gone, made that decision. April 11th, 2017, the was staying in a hotel of
forwarded the teams in the same hotel
space before games, so that
everyone was pretty into the finals. I was in the office and
we're heading to play in the quarterfinal against AS Monaco at Signal Iduna Stadium, which is in the center of Dortmund. Shortly before 7 p.m., the players of the team boarded their official team bus.
When the bus took off the parking lot of the hotel and turned on the street, there were three detonations, 3 bombs that exploded and hit the bus of Dortmund.
3 explosions occurred close to the Borussia Dortmund team bus. The B team bus had just left the hotel. The explosions destroyed 2 windows in the rear part of the bus.
People screamed, people jumped to the ground.
The fellow Dortmund fan I was supposed to watch the match with, he called me and said, turn on the TV, there was an attack on the Dortmund bus, and I thought he was like, that was impossible.
Some of the players screamed at the driver to keep driving as fast as possible because they were worried that people might storm the bus.
German investigators say the explosive devices used in the attack on the Borussia Dortmund bus contained metal pins, and that one had pierced a seat headrest.
Unbeknownst to the team members, the actual mastermind behind the attack was, as they were disembarking the bus, was actually eating steak and sweet potatoes at the hotel they had just left.
Authorities are attempting to verify a letter left at the scene claiming jihadists were behind the attack.
Because there had been a series of attacks by Islamic terrorists in Germany and Europe, there was widespread suspicion in the media that this was another Islamic terror attack. 3 letters were found at the site of the bombing that took credit for the attack on behalf of Islamic State. There were, however, reasons to doubt this particular narrative.
Would actually be a surprise if ISIS were actually part of this attack. Possibly could be employed by other groups like the far right wing to try and shift the blame.
The letters had some strange qualities. They were written in a strange German that used big, sophisticated words, but had basic grammar mistakes, as if someone was native German speaker, but pretending to be a foreign person.
Federal investigators have detained 1 man suspected of links to Islamist terrorism, one of 2 suspects whose apartments were raided this morning.
Shortly after the bombing, a man in Austria named Rudolf, who was a big BVB fan, he noticed that something strange was going on the stock market related to the team's shares. He emailed the lawyers of BVB, who then forwarded that email on to investigators. The email stated that someone had bought 60,000 BVB put options, a wager that the value of the shares of the team would fall below a certain amount at a certain date.
Why would someone buy that ahead of a match and then 3 bombs go off? Something isn't right here.
For the person to make money off of that, it required the stock to go down quite a bit in a fairly short period of time. And it wouldn't just be the team losing a match, it would require something much bigger than that. There was another big red flag about this purchase, which is the fact that it had actually been made, number one, on the day of the bombing, but also from an IP address that had been traced to the actual hotel where the bombing had taken place.
When 3 explosions targeted the bus carrying the Borussia Dortmund footballers on April the 11th, written notes left at the scene claimed the attack was the work of ISIL. The truth, as is now alleged, is remarkable.
On April 21st, the police arrested a man in a southern German city called Tübingen. He was on his way to work, and his name was Sergei Venergold. He seemed like an unlikely suspect because he had no known connections to the Islamic terror world. He didn't seem like a far-right extremist. He didn't seem like a left-wing extremist either. He seemed to be a completely unremarkable young man.
A 28-year-old German-Russian man, named only as Sergei W., stayed in the same hotel as the players on the night before the bombing. He specifically requested an upper room overlooking the bushes where the explosive devices were hidden.
The media dissected why he would do that, what was his past.
He had been inspired by the 2015 terror attack in Paris. And he noticed that in the aftermath of the attack, the stocks of French companies went down. And he believed that if an attack took place that was directed at a specific company, that the decrease in stock price for that company would be even more dramatic.
It never occurred to anyone that someone would do that out of greed.
We now know that the suspect bought 3 different derivatives on the Borussia Dortmund shares. With all these derivatives, he bet on falling shares. The suspect bought the majority of these financial products on the 11th of April, the day of the attack.
If the plot had been completely successful and the stock had reached a value of 0, Venergold would have made up to 570,000 euros, or the equivalent of about $608,000. Ultimately, the plan completely backfired.
The attacker, Sergei Venergold, didn't make any money. In fact, he lost money.
In court, he would be extremely quiet. He usually kept his hands clasped together. One of the lawyers actually commented that he had never seen a defendant act so calmly. Venergold had served some time in the German military. From that information and from online research, he was able to figure out how to assemble remote detonated bombs that would do what he hoped to do. There were a few days of extremely emotional testimony, including the soccer players who described doubting whether or not they could ever play another game again.
It brought everything back up, and it didn't quite help them to kind of process what was going on.
Throughout it all, he sat there completely silent. The big mystery that was swirling around the trial was the question of why. He may have simply done it because he wanted to impress a woman. Rebecca is a young woman who has a very troubled home life. She ultimately sees her relationship with Venergold as an opportunity to leave that troubled home. Venergold is a Russian immigrant to Germany. He speaks with an accent. He has anxiety in large groups of Germans. She begins to resent the fact that he has these fears and feels a little bit trapped. Rebecca attempts to dump him on multiple occasions, and he threatens to commit suicide if she leaves him. Venergold apparently told Rebecca that she would soon be seeing a surprise. After being dumped via text message, he apparently began planning for this attack in earnest. Gold was charged with 28 counts of attempted murder, which carried a maximum sentence in Germany of life in prison. He claimed that he had nothing to do with the attack, but as time went on, he admitted that he had actually been the person who had built the explosives and had set them off. But he claimed that he didn't want to actually kill anybody. Ultimately, Gold didn't receive the harshest possible sentence. He was given 14 years in prison, but it's still a considerable amount in jail in Germany.
The threat of an asteroid hitting Earth is very real. If it's big enough, it's also very final.
These are very, very infrequent events. The probability is not zero, though.
A blinding flash of light streaking across the sky.
About 100 tons of space rock falls on Earth every day. Most of it is so small it burns up in our atmosphere or lands unnoticed away from major populations. No human in the past 1,000 years is known to have been killed by a meteorite, and according to NASA, no large object is likely to strike the Earth any time in the next several hundred years. However, one thing is certain: we haven't found them all.
There are thousands out there, and we don't know where they are.
There are a lot of asteroids in our solar system. They number in the billions.
Scientists all over the world are working toward detecting and deflecting the most catastrophic of natural disasters.
The race is on to find as many of these objects as we can.
We have a way of calculating whether or not an asteroid is potentially dangerous or not.
I mean, I think it's something worth investing in. It's our existence at stake, right?
Amy, let's get this one out of the way. It's probably the question you get asked the most, but how scared should we be?
Asteroids and comets are a natural hazard that's out there like a lot of other natural hazards. These are very, very infrequent events, these collision events, where an object actually impacts the Earth. The most important thing that we need to know about asteroids is when the next impact is going to happen and how bad it will be. What we know is that an object that's about, say, a kilometer across is capable of causing very, very wide devastation across the planet, really, truly global devastation. The object that wiped out the dinosaurs was somewhere in the neighborhood of 5 to 10 kilometers across, so even bigger than that. At a kilometer, it's still going to be very bad and will have global effects. For objects that are capable of causing what I would call sort of regional damage, kind of a large major metropolitan area, a city and its surrounding environment, sort of around 100-ish meters. It depends on the details of the composition and so forth.
By the 1980s, NASA was cataloguing near-Earth objects. In 1994, stargazers watched as comet Shoemaker-Levy 9 hit Jupiter. The resulting zone of chaos was estimated to be as large as the Earth, and the event became a turning point in the search for asteroids and comets in our solar system. In 1998, Congress tasked NASA with finding 90% of asteroids and comets 1 kilometer wide or larger. Soon after, Hollywood blockbusters Armageddon and Deep Impact brought attention and fear to the masses.
The great news is that the vast majority, more than 90% of all the really large 1 kilometer near-Earth objects have been found. The challenge now is working down to these smaller sizes that are still quite capable of causing a lot of damage, but they're just harder to spot because they're fainter, they're smaller.
Can you give us a sense of how many are out there in our solar system?
We know that there are a lot of asteroids in our solar system. They number in the billions. Most of them, however, are between Mars and Jupiter in what we call the main asteroid belt. This is a region of space where most of the asteroids in the inner part of our solar system live, and they stay there for many billions of years. There is another population, though, that kind of leaks inward and gets into the region somewhat close to the Earth, and we call these near-Earth objects. We think that there are millions and millions of near-Earth objects that are out there in the total population. As of today, we know of sort of around 20, 25,000, something like that. When we first spot an object, we really know very little about it. We just see something moving across the sky. So all you get is just sort of a handful of snapshots, just enough to be able to tell that this isn't an asteroid that we've already seen before. And then once we can calculate the distance to it, we can now start to make predictions about its true size. Is it large or is it small? So we have a lot of information that we have to get pretty quickly to really understand what's going on.
Finding asteroids is just one piece of the puzzle. Planetary scientists are extremely skilled in determining the orbits and speeds of asteroids based on relatively small amounts of data. NASA runs simulations of the trajectories asteroids could take, which is useful but time-consuming. A team of scientists in the Netherlands have found a way that could buy us more time.
Our method is very quick. So you can very quickly get an assessment of whether or not the object is dangerous or not. If you look at the classical way of determining the danger of an asteroid, it may take days of computing time on very big machines to determine this hazardousness.
The current problem is that there's just too many asteroids out there to spend a huge amount of computational power on all of them. So the neural network allows us to focus on what really could go and pose a hazard to Earth.
A neural network is a computing system that mimics the way the human brain operates to find underlying relationships in a set of data.
By training the network in this way, you train it in recognizing those objects that are most likely to hit the planet. And once it's trained, you can apply this network to all the unknown asteroids. And then you can make a selection and saying, hey, these are the ones which appear to be having orbits similar to the ones which we know are hitting the planet. That doesn't mean that they do, but it only means that they look very similar to the ones we know they do.
What else did you find? Should we be particularly concerned about anything?
One thing that we did find is that our neural network was able to go and identify a handful of asteroids which weren't considered potentially hazardous, that when we went and integrated them forward in time, they came quite close to Earth.
We find a handful which were not detected before or not considered being dangerous before, and we think they are potentially dangerous.
It's very hard to simulate kind of going forward in time an asteroid that's going to hit Earth because, well, the Earth is really small. And space is really big, and then you have to have very exact parameters to shoot an asteroid that goes and hits exactly Earth. And then Simon had the ingenious idea of not even trying to do that and just launching the asteroids from Earth's surface and integrating backwards in time.
It's very hard to make it hit. So you need a lot of calculations which all end up in nothing. And the idea was then let's not do that. This is basically what NASA is doing. NASA is taking an asteroid, making multiple copies of them, shooting them all forwards in time, calculating their orbits, and then see what fraction sort of gets close to Earth. Not even hitting Earth, but getting close to Earth. And that they call it a potential impactor. So you calculate the solar system forwards in time for, let's say, 1,000 years. And then you launch asteroids from the surface as if you go forwards in time, would fall on the surface. You calculate them backwards to today, and then you get your orbital parameters of today's asteroids, which you know will land on the planet. And those you can use as known impactors and compare with all the other asteroids in the solar system.
Can simulations and AI, can those things fill in the gaps where perhaps telescopes and other imaging tools can't?
Absolutely. Since the observations get more complex, the physics gets more complex. And if the physics get more complex, the mathematics becomes more complex. And at some point, you can't solve your problems analytically anymore. And then this is where the computer comes in. Now we have this trained neural network. We have a way of calculating in a fraction of a second whether or not an asteroid is potentially dangerous or not, and therefore deserves more attention or more time to spend on for really finding out if it is dangerous.
When it comes to hunting asteroids, time is critical.
What we can do about a potentially hazardous object depends a great deal on what we know about it and how much time we have before the encounter. We'd really like to find them when they're decades away, because the more time you have, the more options you have, and the less energy it takes to move an object aside.
It also means we might not have to resort to launching a nuclear warhead at an asteroid. Until recently, pretty much our only choice.
That's an option of last resort, in my opinion, yes. We have lots of options available. You can just simply bump into the object and just nudge it out of the way. That's one possibility, and that's kind of, in a way, sort of the simplest thing to think about, just nudging it off its path a little bit with, a massive object, a spacecraft, let's say. It's just kind of like bowling, if you will. If you have a long time or a long stretch of runway in the lane, just a very small twist on the bowling ball will make a big change in where it ultimately ends up. Another option would be something where you take a very big, massive spacecraft and you park it next to the object and you use the force of gravity as a towing rig. That takes longer, though, and you need to be able to send a pretty massive spacecraft, and it obviously depends a lot on how big the asteroid is. Other options start to get more and more complicated, and they range from painting one side of the object a white color and painting the other side dark, and then letting the pressure of light sort of perturb its orbit.
In a departure from the lab and computer simulations, NASA has real plans to rehearse kinetic impact deflection. In 2021, the agency will launch DART, the Double Asteroid Redirection Test mission, which will intercept a 160-meter asteroid in 2022. Better to practice now before we have to deal with an actual threat. In the meantime, discovering asteroids is our best bet. Thousands of scientists and amateur astronomers around the world make up an informal network that survey the heavens. But that may not be enough. NASA wants more resources to map our solar system and better technology.
We need to ramp up our network of sensors, and also we need to just continue to strengthen our network of international observers so that we can get follow-up, because we find these objects when they're distributed all over the night sky.
Once we get more observations, we get better data, we can make better predictions.
If you look at the big impactors we have had in the last, let's say, 20 years, or maybe 30 years, 50 years, most of them we haven't seen coming. So the real danger, I think, comes from the objects we don't know about, and not from the objects we do know about.
This particular natural disaster, like a lot of natural disasters and like climate change, is a problem of the global commons. So the thing that we risk collectively is that it sort of then becomes nobody's problem, and nobody takes ownership over it. The asteroids are all over the sky. They just truly cross boundaries and borders with a second's notice.
I kind of imagine in the future, maybe lots of small satellites around the Earth that are always going and looking outward. I mean, I think it's something worth investing in. It's our existence at stake, right?
The pandemic has affected everyone in different ways. Some pass the time by baking.
Homemade sourdough bread. Do I need to say more?
Some chose to binge watch Netflix.
It's your game.
Or maybe you started a garden oasis in your backyard.
Next, I'm going to put my lettuces in.
But for millions of others,
I'm going to be posting stocks that will boom.
They wanted to uproot the financial industry.
Let's just lock it on up and take $15,000.
Here's a stock that can change your life.
I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it.
I have gained over $3 million.
I want some free money.
I don't think you can overstate the online communities or social media's influence on financial markets.
A large group of inexperienced investors who discuss their plans on social media platform Reddit have shaken up the stock market in a big way.
The stock that everybody's talking about right now is GameStop.
Video game retailer GameStop is set to continue their head-spinning ascent today.
The revolutionaries on Reddit are spanking Wall Street's ass.
The more these stocks go up, the more the big guys are getting creamed and losing billions of dollars.
This isn't a wealthy person's game anymore. Anyone can play it.
I took up a little bit of a new hobby, and I am interested in day trading.
As an investor nowadays, you don't have to look a specific way. You don't have to wear specific clothes. You don't have to be doing it from a trading floor on Wall Street in like a high-rise building in downtown Manhattan.
The narrative of what's driving the markets is no longer being held in secret offices in New York and Boston of privileged people talking to other privileged people. It's right out in the open. It's on Twitter, it's on Reddit.
From brokerage apps to Discord channels and subreddits to TikTok finfluencers, one of the last holdouts in the world of disruption, finance is next in line.
Investing should be as ubiquitous as shopping online.
That's Vlad Tenev, the CEO of Robinhood, the online brokerage app, talking about how he wants his app to disrupt the world of stock trading like Amazon disrupted the world of home shopping.
And I think that speaks to exactly the mission that a platform like Robinhood has, which is to democratize investing.
Robinhood was started in 2013 by Vlad Tenev and Baiju Bhatt in, where else, Silicon Valley, as an alternative to the big brokerages, but with one big difference.
As they were building the social network around finances for people, they realized that there was a gap in the market and that free trading could become something that they could bring to the markets, they could disrupt the industry.
While no-fee trading is industry standard today, it was unheard of when it was first introduced.
The online brokerage industry was really innovative when they came on the scene 10, 15 years ago, but they kind of stopped innovating where you haven't seen those commissions come down beyond $5 or $6 or $7. Robinhood think that by offering zero commission that they're going to push people onto this platform.
And on top of no-fee trading, the customers Robinhood was courting have been long overlooked in the world of finance.
So the typical customer of a Charles Schwab, for example, is putting a lot more money in that brokerage account than the typical customer at Robinhood. Even today, with all of its popularity, the median account size is about $240.
There's Fidelities and the Schwabs and the E-Trades of the world. They look down their nose at those kind of accounts. I don't want a $1,000 account. They're just a headache. I want a $100,000 account.
And this is key here, right? Because the thing about Robinhood that's different than every other single brokerage platform is how easy it is to use.
The design of the Robinhood app really has in mind a user who might be coming at this absolutely cold.
The fonts are very well sized, the shapes, the colors, all of that is something that the founders of Robinhood paid really close attention to.
And by creating an interface that catered to a newer investor, they were able to gather a pretty healthy group of customers. And by 2019, they had about 10 million customers.
Those 10 million customers were a huge success story for Robinhood, but no one could have predicted its explosion after the arrival of COVID-19.
Remain indoors to the greatest extent, and 100% of the non-essential workforce must stay home.
What we saw when the pandemic hit was the growth of Robinhood users absolutely turbocharged. And oddly, you saw this surge in interest in stock trading. Then they saw the absolute surge in 2020 in customer growth. And now, by many accounts, they have more than 20 million customers, which is pretty extraordinary. So the next step for them is to figure out how to monetize those users and how, even with their small account sizes, to get them to grow with the company and, as it releases more products, come along with them.
Robinhood would become one of the COVID economy's breakout successes. Robinhood traders, as they're called, became the shorthand explanation for the frenzy of often speculative retail investing after the pandemic lockdowns.
Kids wake up in the morning, they go on Robinhood. They're, in the shower, they check Robinhood. Kids are learning how the stock market works at 18 while they're at school, checking their phones in between classes because notifications pop up telling them what their stocks are doing that day.
With these new tools, millennials and Gen Z are investing in the market in ways their parents could have never even dreamt of.
That is sort of key when we talk about the divide between older and younger generations, is that the younger generation is exposed to so much more information and tools at their disposal to do what they want in the market.
The older generations, you never had the technology or the cost structure that you could play the markets like you can today. So you were stuck with giving your money to a professional investor and paying them a fee to do it.
When I speak to young kids, they tell me, I'm making mistakes, I'm losing money. I'm not a perfect investor, but I'm 18, and by the time I'm 30, which will be, 10 years from now, I'm gonna have interacted with the markets for a decade. And so it's a learning experience more so than anything else.
And you can look at it and you can say, wow, that's risk-taking, that's dumb, but if you could possibly shave 10, 20 years off your working life versus adding 5 years, I don't think you can fault people for that.
But Robinhood is only part of the puzzle. Sure, you can trade on it, but without research, information, and data, you're just blindly throwing darts at different stocks and hoping to strike it rich.
Wall Street forever has always run on what we now call narratives or memes. People telling rumors to each other have been around for 100 years.
On Wall Street, information is its own currency. Historically, either you had it or you didn't, and the people who had it had a huge advantage.
In the past, those narratives and memes didn't have a network effect. It would be one person telling another person over the phone. In fact, when I broke into this business in the 80s, a lot of people used to complain that they weren't on the call list to get those ideas.
Social media changed all of that.
Fast forward to 2021, that's being done on the internet now. And that's being done on Discord and Twitter and StockTwits and Reddit. And the impact is very similar, but orders and orders of magnitude larger.
As social media has played a bigger part in our lives, it's also played a bigger and kind of more important role in how people find investing ideas online and on these platforms.
How do those ideas spread? On TikTok. Yes, that TikTok.
Soon may the weatherman come to bring us sugar and tea and rum.
People aren't just going to it for sea shanty videos.
The personal finance hashtag on TikTok has garnered 3.5 billion views from its 1 billion monthly active users. By comparison, videos found under the cooking and health tips hashtag have 2.6 and 2.1 billion views respectively.
The trajectory of Robinhood and TikTok were literally on par.
What happened in the stock market this week? So the word of the week is expectations.
Absolutely essential that you guys understand the risks of shorting.
And Kayla Kilbride and Kyla Scanlon are two of those financial influencer TikTokers, also known as finfluencers.
I think people still care about fashion, they care about culture, but it's also like there's this big behemoth thing called the stock market that we really don't know a whole lot about, and it's gatekept behind the industry. And so people like want to unpack that. And so my audience is a lot of them are younger investors who are looking to hone their skills.
Tech and write up.
Kyla and Kayla are two of the more, let's say, professional TikTok influencers.
The Tesla ARK Bitcoin Biotech Risk Cluster.
I've been trading since high school, and it was a really interesting way for me to fill out my decision-making frameworks and to think about thinking. And I think that the more that we can have people thinking about finance, the better that we're going to progress as a society. I think it's a huge gap in our educational system.
If you're going to buy an option for a stock you think is going to go up, it's a call. So think of it like this. I made the options video where I was like, options are just like shopping. Rumor has it that this pallet's about to go up in price. So if I come in tomorrow, can I still buy it at said price? And a ton of women just like attacked that video and were like, you explain things so much better than my boyfriend or my professor, or like I could sit and listen to you all day. And I was like, this is what I was looking for.
But TikTok's algorithm does not reward calm and measured videos about responsible investing. It rewards this.
Watch this video for 30 seconds and you'll be rich for the rest of your life.
I try not to say the A word, the ALGO word, because TikTok listens to us.
The algorithm does impact how you feel. You know, you do notice which videos do better versus which videos do worse.
How do you catch someone's attention in less than 60 seconds? And how do you make it something that they're like, I need this in my life? Nearly impossible to do that in 60 seconds. But the people who perfect it are the people that you're going to watch and going to stick around.
And where people are sticking around? Reddit. And its nearly countless subreddits about finance. And by far the biggest one of those is Wall Street Bets.
There's a lot of social media platforms out there, but Reddit is like the social media platform for finance. Places like Wall Street Bets is where it all goes down.
Started in January 2012, it wasn't long before Wall Street Bets adopted a 4chan-like etiquette, leading to their tagline, like 4chan found a Bloomberg terminal.
We had all these unexplained stock moves, and we would be grasping for why stock XYZ jumped 20% in a day. And you would look at Wall Street Bets, and you would see people there talking about buying options in that stock, and it sort of, squared the circle, so to speak, and started making sense. And it was at that point that it was like, wow, we have to start paying attention to this.
Some people on the platform really spend tons of time, and others are just looking for entertainment and to have a little bit of fun, effectively gambling or looking for an outlet, trying to make a little bit of money.
Then on top of all of that, there were stimulus checks. Now, clearly, this money is going to people who need to use that to eat, to live, but there's a lot of people who use this money to invest in the stock market.
And it's not just stock tips. People quote-unquote YOLO their entire life savings or stimulus checks on a single stock. They post what is called gain and loss porn, screen-grabbing staggering hits and misses on stocks for the entire community to see.
I'm about to lose everything.
And while some of the people on Wall Street Bets are novice investors, the community contains multitudes.
In one respect, what it did show us among these network groups is they are very sophisticated. They're not a bunch of ignorant people talking to other ignorant people.
And this is where the pieces of the puzzle all come together to wreak havoc on Wall Street for a solid week in early 2021.
It's pretty clear that the combination of more people having retail brokerage accounts and trading apps and more people being stuck at home looking for some kind of entertainment and some kind of community online came together in this very singular way.
What came together is GameStop.
Let's go back to the beginnings of what happened with GameStop a couple of years ago. On the boards like Reddit and StockTwits, a lot of people were talking about GameStop as being attractive value.
Some of them are even, Wall Street alums who left the industry and now still have access to tools that they can use to improve their financial well-being and make very good decisions. And I think Roaring Kitty is a perfect example of that.
GameStop is one of the most compelling asymmetric opportunities in the market today. Really, I don't understand how you could disagree with that.
At the same time that this crowd was talking it up, The hedge fund institutional crowd didn't like this stock at all, and it had the largest short interest of any stock in the New York Stock Exchange going into late 2020.
Short selling is a bet that a stock price will fall, and it's a fairly simple concept. An investor borrows a stock and then sells it. The investor is betting on buying the stock back later for a lower price before returning it to the original owner, pocketing the price difference.
What a short seller would tell you is that they almost act as a policeman in financial markets, or they're at least looking for companies that aren't what they say they are. And that can range anywhere from an outright fraud that some short sellers try to expose to just a company that's not worth as much as investors think it is.
The problem is, if the stock price rises, the short seller has to come up with the money to buy the stock back. And the more it rises, the more it costs. And that's what's called a short squeeze. And the hedge fund Melvin Capital was on the wrong end of that squeeze.
Melvin Capital lost over 50% of its money in the month of January alone, just from being caught in the short squeeze of the stock.
This is where the disruption comes in.
One of the most wild stories you're ever going to see. GameStop shares absolutely going nuts.
In less than a year, the company's stock has jumped from less than $3 a share to almost $350. Cheers, everybody!
Roaring Kitty has turned $50,000 or so investment into some $14 million.
Whoa!
Investors all over social media use the free trading app Robinhood to wreak havoc on Wall Street.
They're actually piling on into some of these stocks to really hurt the professional short sellers.
And they all used Reddit, Twitter, TikTok, and Discord to tell one another to keep buying and, quote, hold the line and not sell GameStop.
People are getting cheerleaded for jumping in, buying at the highs. They're saying, keep going.
And it was working too, until
Thursday morning, the trading app Robinhood sent out this tweet. In light of current market volatility, we are restricting transactions, including GameStop.
People were really angry.
Robinhood was supposed to allow the regular people to play the same game these big boys are playing. But instead, we were all taken for schmucks, and they screwed us.
Shares of GameStop are jumping again now that retail investors are being allowed to buy shares of the stock.
But what we learned is that when people organize online, they have the ability to disrupt the market.
And it was a big sign. The ivory walls of the institution aren't as powerful as maybe the institutions thought them to be. I don't know if pumping up GameStop was the best use of billions of dollars, but I think that as a signal to society, it was pretty interesting and powerful.
The GameStop saga was so impactful that both Vlad Tenev and Roaring Kitty were called in to testify before Congress to clarify each of their roles in the saga.
One thing that's emerged from the congressional hearings is that they're interested in how retail brokerages make money and whether they're keeping the best interest of their customers in mind, but it's pretty fuzzy as far as what they would actually do as a result.
While the frenzy around GameStop eventually subsided, it didn't take long for retail investors to find other areas to invest their money.
Take a look at Bitcoin going bananas over the weekend.
Bitcoin forms a brand new all-time high.
It was after GameStop started to drop that we saw Bitcoin really go up to over 60,000.
How much further does this rally have to run?
It's compelling to say that money shifted from one venue to the other.
While correlation doesn't equal causation, there's a chart out there showing an inverse correlation on meme stocks going down and cryptocurrencies going up.
There's definitely an aspect where people are making money on stocks and then moving, they're agnostic, they're not hedge funds. They can invest wherever the hell they want. It's a classic sort of momentum trade. They're going to wherever the winners are and they're willing to jump on and, ride it.
So whether it's meme stocks like GameStop, meme coins like Dogecoin, or entirely new ways to invest in art like NFTs, the new kind of retail investor is making its presence known.
Over the next 10, maybe 15 years, you're going to continue to see, whether by choice or by force, that baton go from older generations to younger generations. I don't think any single app is going to be the thing that disrupts. I think people are the disruptors.
How people get ideas about what to invest in has become increasingly entwined with social media. And as social media companies govern more and more of our lives, the fact that now they're tied in more intimately to people's wallets is something that we might want to understand better.
Usually what disruption, I think, means is technology comes in, whether it's blogs to the newspapers or online retailing to brick and mortar. They come in and they're in the same business, but they just do it in such a gigantic cost savings that it causes everybody to switch. Well, that's the risk that happens here, is that it's so much cheaper to just manage your own money. We're not there yet, but costs and conveniences are moving in that direction. So I'd say, Wall Street, you haven't been disrupted yet, but you could be in the coming years, and that the final chapter on this story hasn't been written.
Meet Bloomberg's own David Nicholson. Now, his happy place is out in the field, on the open road. But like the rest of the world lately, he's been working from home a lot more than he's used to. COVID-19 has prompted a massive urban exodus as professionals of every ilk yearn for more space to live and work. As a result, rural areas have exploded, and they're poised to experience a resurgence as more and more families pack up and leave the big city to try out life in the burbs. But there's one problem with that. Not all internet speeds are created equal. Anyone who might need to upload or download large files for a living may not want to pack up and move to that cabin in the woods just yet. Now, David's house isn't a cabin, but it is in the woods, and inexplicably, his internet is workable.
My internet is okay. I pay a lot for it. It's around $140 a month. The download speed's great, and the upload speed is terrible, which is really bad for my work because I have to upload these massive files. But I'm definitely one of the more lucky ones in this community. Just a few miles down the road, my buddy has awful internet.
It's usually under 2 down and under 0.2 up, so it's often unusable.
Some days it's around 1, and other times it'll drop down to about 0.2, 0.3.
I just want to be able to have internet at my house without having to go outside the normal ways of acquiring internet. It's really frustrating.
We're literally a few miles away from downtown, and it just cuts off.
This is a problem, and the solutions are not there yet, because getting high-speed internet in rural areas en masse is something our providers may simply not be ready for.
If your internet service doesn't have fast download and upload speeds, then you don't have high-speed harmony. You have.
Americans on average pay about $70 a month for internet at home. But in rural areas, it could cost a lot more for a lot less service.
So the pricing for a fixed wireless provider here can be something between $80 and $150 for about 25 megabits per second. However, gigabit service, which is 1,000 megabits per second and symmetrical, is running at about $119 a month or $130 a month.
That's John Paul. He co-owns Spiral Fiber, an internet service provider here in Nevada County, California. And for the past 10 years, he's been trying to bring an affordable fiber optic network to town. It all started when he applied to be part of the pilot program for Google's fiber service.
Across the country, civic boosters have been going to extremes, chanting, singing, and marching trying to get the search engine giant to look at their town.
The internet these days is crucial to be in the world, to be a part of the world, and to be connected to your community.
Google ultimately went with Kansas City, Missouri, which left Paul on a mission to get funding to lay out fiber optic networks for gigabit service. Over the next several years, he would attend conferences and pitch venture capitalists and apply for grants to make his vision come to life.
One of the biggest roadblocks to building infrastructure for the internet here in the United States are the existing large providers. They have their land staked out. They would prefer that nobody come in and compete against them. In 2013, we applied for a grant. We went down and met with the commissioners at the California Public Utilities Commission. It was an arduous process to get funded, but we finally did against all odds. We got a $16 million grant, and then we went out to seek venture capital.
Then, in March of 2020, the pandemic hit the world.
Everybody got locked down, and everybody came home, and everybody started using the internet. And I remember seeing on one of the local fixed wireless providers' websites, they've said, hey, we know you're all staying home, but please don't use too much video, and please don't use too much bandwidth. And I thought, that doesn't work.
The U.S. connectivity gap is far greater compared to countries that are considered its peers economically. Some developing nations actually have better internet than rural America, like in Kenya, which has a state-of-the-art fiber optic network fed in from their coastline. The American connectivity gap does largely affect rural areas that are either outside of service coverage or simply prohibitively expensive. This is Rebecca. She and her family moved to Nevada County just a couple miles down the road from David. They took for granted that high-speed internet would just exist in the area, and it's not something they even bothered to check on before buying their house. Turns out, all they got was dial-up.
We wanted to move where we had a little more space, room for the kids to run around, just be out in the mountains a little bit more. Having come from a bigger city area where Wi-Fi is pretty readily available, we hadn't really considered that in our purchasing of the house, whether that would be an option or not. When school started, and now that we are remote learning with our children and we're doing everything from home, we didn't have the option to do that at our house. So every day when school would start, we'd have to pack the kids up and we'd go to my in-laws' home. They have a little cabin up in this area that does have Wi-Fi already.
Rebecca's situation is the norm in rural America.
According to data from the Federal Communications Commission, just 4% of urban Americans lack access to broadband internet. That's compared to almost 40% of people who live in rural areas. But while that was the case, there were also racial and socioeconomic divides in terms of who had that access. In addition to that geographic difference, low-income African American students, Latino students, and first-generation college students were more likely than others to have only one device at home that's shared among multiple siblings and or lack access to that actual connection.
For most American towns, there's also a lack of competition, forcing internet prices up. And large providers like AT&T and Comcast aren't incentivized to expand service to these rural communities.
This is how Xfinity makes life simple, easy, awesome.
So in our area, we have a small imprint of Comcast, but they're not going to go out to the more rural areas. It's just not cost effective for them to do it as a large company.
In order to lay fiber cable, you're actually physically digging trenches into the ground. And for internet service providers, they're primarily focused on maximizing their profits. And so the fewer customers you have, in any square mile and the more fiber you have to lay, that's just kind of harder to pencil out from a purely economic standpoint.
AT&T released a statement on the matter, expressing the need and desire for government assistance to fund fiber optic expansion to areas deemed unprofitable. Comcast released a similar statement encouraging more public-private collaboration on this effort. Federal agencies do offer grants to help communities build broadband networks, but many have argued that there's not enough flexibility on how to use these funds. The COVID-19 relief package passed by Congress in March and signed by President Donald Trump awarded $43.3 million to 51 projects on the East Coast alone. But it also stipulated that these projects needed to be up and running by December 30th. For contractors who plan projects months and years in advance, it's a scramble to rearrange their schedules to meet that deadline.
So what we've been asking the federal government to consider is at least have, as long as the projects are getting started, knowing the projects are being put into place to expand both remote learning, working from home, and opportunities like that that are truly driven from COVID. We're moving as fast as we can regardless, but hopefully they'll give us some more time.
Talking to John Paul, it's clear that